presuming that the inflation data comes in relatively in line, right? There's a pretty clear path for the Fed to cut.
You're seeing inflation moving closer to the target. In that environment, you have to be closer to neutral.
They can continue a sequence of rate cuts, and they have a lot of room to cut interest rates here.
Inflation is really looking like it's getting back under control, that kind of the battle against inflation has been won.
The inflation question is back on the table.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
We're live from Tampa later this hour as Hurricane Milton batters the state of Florida. The latest headlines just moments away. Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now with equity futures pulling back just a little bit on the S&P 500. We're negative by a tenth of 1%. Coming into CPI Thursday after posting a 44th all-time high of the year on the S&P 500. On the Nasdaq 100, we're down a tenth of 1%. In the bond market, 2-year, 10-year, 30-year, four handles across the board on a 10-year, approaching 4.1%. Yields up across the board in yesterday's session, going into CPI, Bramo, later this morning.
Which raises the question to me, how much is this market poised for a rally if CPI comes in lighter than expected, if there is a downside surprise and inflation is no longer on the table? Have we basically priced out some of the euphoria around excessive rate cuts and then opened up the door to a reigniting of all of that all again because this is the year of cycles?
The risk to the markets definitely seems like CPI coming on the upside. Remember, before that blowout jobs report, everyone was saying, ignore CPI Thursday. You don't have to care about it. This is a single mandated Fed. Mohamed El-Erian comes on and said inflation is not dead. He says that blowout U.S. jobs report is yet another good reason for the Fed to maintain their dual mandate approach.
Had a ton of Fed speak in the last 24 hours, a sprinkle of Fed minutes as well. Some participants observed that they would have preferred a 25 basis point reduction at the last meeting. Was this a Chairman Powell 50 basis point cut or what?
Well, it seems like he definitely jammed this through. There was a little bit more dissent than maybe it seemed on the surface, with just one official dissent. That said, my takeaway from this was catch up. This was basically, we should have gone in July. We kind of messed up. We're going to bake this in, but don't expect anything more. I was just going through some of the Fed speak. Not only did Mary Daly say that she only expects one or two more 25 basis point rate cuts for the remainder of this year, but even Neil Kashkari in the past few weeks has said, as we go forward, I expect on balance we will probably take smaller steps unless the data changes materially. Even him.
Next stop for this debate, 8:30 Eastern Time, CPI in America, inflation just around the corner. Coming up this hour, here's the lineup for you. Coming up, we'll catch up with Bill Wadell of Accuweather as Hurricane Milton strikes Florida, Brian Levitt of Invesco as stocks hit fresh record highs ahead of CPI, and Tom Narayan of RBC ahead of Tesla's robotaxi event. We begin this hour with Hurricane Milton moving across central Florida after making landfall near Tampa as a Category 3 storm. The state facing winds of 85 miles per hour, with flash flood emergencies in effect in nearly 3 million homes and businesses without electricity. Bill Wadell of Accuweather joins us now from Sarasota, Florida. Bill, welcome to the program, sir. Just walk us through the latest developments and what you're seeing play out overnight and through this morning.
Good morning to you. Yeah, a tough night here in Sarasota, Florida. It is dark because the power is out except for emergency generators. We had roughly 3 feet or more of storm surge in these streets. Some places we know it was higher. We're talking about a lot of water damage that has made it into businesses here in downtown Sarasota. Right here, you're looking at an air conditioner unit that used to be on top of one of these high-rise buildings. So in those overnight hours, the storm surge waters did recede. But I could tell you some dangerous situations. We saw drivers caught out in the middle of it. They let their guard down in the eye of the storm. They had floodwaters to their SUV up to the headlights, even going over the hood at points.
Bill, can you just give us a sense of where the storm is, how much damage has already been incurred, what we know and what we don't know as we track the progress of the storm and its aftermath?
Absolutely. We're going to have a lot more information in the next few hours once the sun comes up. We're dealing with emergency responders going around, a lot of debris in the road, so we can't really get a full assessment of the damage just yet. Again, as Milton continues to push inland across Florida, we're seeing more of those storm surge impacts, obviously, central Florida, now the east coast of Florida. I can tell you this has been a tremendously costly 2 weeks here in the United States. Accuweather experts are estimating that the total damage and economic loss from Hurricane Helene in the United States, remember, less than 2 weeks ago, $225 to $250 billion in total damage and economic loss from Helene. Now our experts are in the middle of that process. We're doing a rapid analysis. We should have more information in the next 24 to 48 hours on the economic impacts from Milton. But our crew at the Accuweather Global Weather Center telling us Hurricane Milton going to be most likely another $200 billion storm when it comes to the total damage and economic loss.
Bill, we heard from Governor DeSantis last night, and he said that this is the largest mobilization of the National Guard in the history of the state of Florida. What else can you tell us about the state and federal response when it comes to the recovery effort?
Absolutely. We can tell you Florida typically handles hurricanes pretty well. Those utility crews, those first responders, everyone jumps in to help. They are well trained. They're used to hurricanes in Florida. I got to tell you, these past 2 years, this has been a difficult situation in the United States. We have overlapping weather disasters. We've been on the road for more than 2 weeks straight now. We just came to this area last week. We were in the mountains of North Carolina, where we saw all of those utility crews, federal responders, state responders, and of course all the nonprofit groups trying to help. So what's happening right now is an ongoing weather disaster up in the mountains of western North Carolina from Helene. So many resources there trying to help families that were completely cut off. So many businesses impacted. Some of those resources stayed in the Carolinas, but we know others, they deployed here to Florida to pre-position. But again, we're dealing with 2 weather disasters in the U.S. in the span of 2 weeks.
The 1-2 punch we all feared. Bill, appreciate the update, sir. Stay safe. Bill Wadell there of Accuweather on the latest. Brian Levitt of Invesco joins us around the table here in New York. Brian, good morning to you.
Good morning.
We're looking ahead to economic data this morning at 8:30 Eastern Time. We're looking back at payrolls from last Friday, blowout payrolls report, and we're attempting to look ahead to more of the same. I just wonder how messy the data is going to be after the 1-2 punch we've seen across several states in America, Hurricane Helene onto Hurricane Milton.
Yeah, some of the data may be messy, but I think the larger themes are still in place. And I know that there's a lot of focus on today's CPI report. The reality is I continue to believe that the inflation story is largely behind us. It's passé. If you look at the Fed's preferred measure of inflation, very much in the comfort zone. If you look at the inflation break-evens, which give you the bond market's expectation of inflation, relatively benign. I mean, the inflation story was one of large stimulus and a pandemic that caused supply challenges. I don't think it's something that is re-emerging. Rather, it's a market that's responded to some good economic activity.
And it's responded as follows: a 2-year back at 4%, a 10-year back at 4%. How are you thinking about the influence of the bond market on the equity market at the moment? I'm
okay with that. I would rather see better economic data and less rate cuts than bad economic data and a lot of rate cuts. You know, the bond market's been moving in this 3.5% to 4.5% range, give or take, this year, depending on the direction of the data. Now, if you think of 4% is a general proxy for what nominal growth will be in this country, 2% real, 2% inflation. So that seems like a reasonable value. As things deteriorate in growth, you come down a little bit. So I think we're probably at the upper end of that range again. Yeah, we had a good payroll report, but if you look at survey data, it's somewhat mixed and doesn't seem like an economy heading into a recession, but doesn't seem like one that's reaccelerating either.
Which raises the question, did the sell-off in the bond market that we've seen over the past few weeks actually raise the specter of a pretty big rally if you get a downside surprise in CPI? In other words, does inflation start to matter a whole lot more again?
Maybe in the short term. But I would say in the long term or in the intermediate term, it's going to be more about growth. And one of the ways to think about it is just look at the correlations between stocks and bonds, which have, become negatively correlated again. So it's become a good news is good news, bad news is bad news type of environment. And so I'm focused on the growth side of this story. When I see a good payroll report or a CPI report that's even a little bit above of what the expectation is. To me, I'm thinking that's a good nominal growth backdrop. That's good for corporate profitability. It doesn't increase concerns to me significantly that this Fed can't ease or the Fed may have to raise rates again or inflation's coming back. Again, I think that's a 2022 story. So
you like treasuries here in terms of where they're at and the value that they're giving. That's what I'm getting from you. We just heard Bill Wadell talk about a potential $450 billion in recovery funds needed to pay for what's going on in Florida. This isn't going to be the last. A lot of people saying these storms coming a lot more frequently. And aside from just the storms and paying for all of this, it raises the question of how much more spending needs to happen and whether that spending can really be tolerated by a Treasury market where the auctions are starting to get messier?
Well, they may be getting a little bit messier, but we haven't seen the Treasury break from nominal growth potential. I mean, people view Treasuries as perhaps trading like a credit. They don't. The Treasury market largely trades on the direction of the economy and what the Federal Reserve is going to do. So I'm not concerned that additional spending will cause rates to jump because we're concerned about the creditworthiness of the U.S. It's a rate that's going to continue to move in line with inflation and with growth. And, you know, it's sort of like every time rates come down, you say to investors, well, you've been sitting in money markets, you should have locked in. This is like the third or fourth bite at the apple they've gotten. People used to beg me for 4%, right? And now this is the third or fourth time they've had the opportunity to take advantage of that beyond 30 days, maybe think about it for 5 years or 10 years. So I think investors should take advantage of it.
Hurricanes are not just going to be expensive, but the fact is they can also increase fuel costs. We are seeing this risk in the oil market, not just domestically, but also internationally, what's going on in the Middle East. What kind of impact do you see from the price of oil, not just on inflation data, but potentially also its relationship with the bond market?
Well, we know energy prices tend to rise late cycle, right? So that's a phenomenon where you get these moves in energy prices, and that's when the consumer rolls over. But let's think of the starting point. So the starting point is the U.S. is producing or is drilling more oil right now than any country in the history of the world ever, right? Some 13 million barrels per day or more. And we started this environment, or we've, you know, the expansion of the Middle East war into Lebanon, into Israel and Iran, and these hurricanes with oil in the 60s in the United States. So we've moved up into the mid-70s, but certainly not the $120 that we were looking at when ahead of the global financial crisis. I drive around my neighborhood, gasoline's, you know, $2.75. You know, 280. So we're not at a level that's, you know, prohibitive. In fact, that's part of the soft landing story. Consumer net worth at an all-time high, gasoline below 3. But yes, if this were to skyrocket significantly, I don't think that's an inflation story. That's a tax on the U.S. consumer story. But U.S. drilling hopefully prevents that.
So what's your biggest risk then to the soft landing scenario?
The biggest risk would be a rollover in economic activity. I mean, we've had interest rates high for a very long period of time. And, you know, usually when the yield curve inverts, you wait 18 months for the Fed to have to normalize the yield curve and you go into a recession. And this time, that has not happened. The bankers were tightening lending standards. Now they're not. Corporate bond spreads are very benign. So it doesn't feel like a recession, largely because most American households have fixed rate mortgages. So the increase in rates hasn't hit. Now, those are famous last words, right? Anytime you're 2 years after a tightening cycle, you're saying no recession. You know, you say, well, I guess we got through this. So that would be the risk. I'm laser focused on the growth side, not on the inflation side. But right now, the evidence suggests it's an economy that's pretty resilient.
Let's finish on earnings. Important 24 hours. Delta, JPMorgan, Wells Fargo, Bank of America, Savita Subramaniam. The bar isn't high. Do you agree?
Yeah, the bar isn't high. It's, you know, the expectations are fairly low. We're likely to surpass expectations on earnings as we tend to do. And again, it's a good nominal growth backdrop. You know, investors sitting here looking at the equity market saying all-time highs on the equity market. Can I invest? You know, we've had, you know, 1,200 all-time highs since the S&P 500 went live. And, you know, people say buy low, sell high. I say buy high, sell higher. And I think we're in a, or maybe never sell. I think we're in a bull market, and peak inflation, peak tightening, peak rates should be good for equities.
He's still bullish. It's Brian Levitt of Invesco. Brian, it's good to see you.
Good to see you.
Thank you, sir. Equity futures on the S&P 500, just a little bit softer on the S&P this morning. We're down 1/10%. Let's give you an update on stories elsewhere with your Bloomberg brief. Let's cross over to Danny Berger. Hey, Danny.
Hey, John. Hurricane Milton is moving across central Florida after making landfall near Tampa last night. The storm is packing powerful winds. Flash flooding emergencies are in effect. Milton reportedly knocked out power for more than 3 million homes and businesses in Florida. It also shredded the roof of Tropicana Field in St. Petersburg, the home of MLB's Tampa Bay Rays. Apple TV Plus is coming to Amazon. The iPhone maker will begin selling subscriptions through Prime later this month, offering access to hit shows like Ted Lasso and Slow Horses on Amazon for the first time. Apple adds to the more than 100 streaming services offered on Amazon's channel store. And Ratan Tata, the former head of Tata Group, who transformed it into a global empire, has died at age 86. He was the chairman for more than 2 decades, starting in 1991. Tata rapidly expanded through major acquisitions that included Jaguar Land Rover and steelmaker Chorus Group. Tata had no children and no heir apparent to lead Tata Trust, which controls the conglomerate through its holding of Tata Sons. And that's your brief. John.
Danny, thank you. Appreciate it. More from Danny in about 30 minutes' time. Up next on the programme, a promise to rescue and rebuild.
We've got your back. We've got your back. And Kamala and I will be there for as long as it takes to rescue, recover, and rebuild.
We'll get the latest down in Florida. Up next on the programme, live from New York City this morning. Good morning. Equities a little bit softer here. We're down 0.1% on the S&P 500. Check out the bond market going into CPI a little bit later on this morning. That data drops at 8:30 Eastern time. Bramo, a 10-year yield, a 2-year yield with a 4 handle. That move sticks.
A lot of people wondering whether this is just retracing some of the euphoria, a beginning of something else, and how worried people are about inflation. Is this really still a one-mandate Federal Reserve? It seems like the expectation is yes. How high is the bar to say, maybe not so much?
Never mind a one-mandate Federal Reserve. It might be a one-man Federal Reserve based on some of the Fed minutes we've had. More on that a little bit later.
Well done.
Under surveillance this morning, a promise to rescue and rebuild.
We have 20 million meals, 40 million liters of water. At my direction, the Secretary of Defense, Austin, has pre-positioned search and rescue teams, helicopters, and high water speed vehicles as close to the storm as possible so they're ready to conduct life-saving missions. We've got your back. We've got your back. And Kamala and I will be there for as long as it takes to rescue, recover, and rebuild.
So here's the latest this morning. The president assuring Floridians of an unprecedented number of assets ready to help with Hurricane Milton's destruction. The White House also criticizing misinformation about the federal response to back-to-back hurricanes in the state. Bloomberg's David Gura joins us now for more. David, good morning. It's good to see you. Is the state of Florida getting everything it needs this morning?
You know, I think we're going to see, as the sun rises and we assess the damage there, what it needs, and indeed, is it going to get that from the state and the federal government? But we've had assurances across the board from the administration and from state leadership that they are going to. But this is a very tricky situation, suffice to say, just having these 2 storms back to back. Having the drain on resources from the federal government and the state government is going to be a real test, I think, for both institutions.
Biden seemed very agitated yesterday and a lot of misinformation. At the same time, though, you do have the running mate of Donald Trump, J.D. Vance, putting this opinion piece out in the Wall Street Journal, basically saying that Harris and Biden are treating the situation like a public relations problem, not like a real problem. Is there any truth to any of that?
I look at these things in complements. So you say misinformation. I think that's what we saw, a lot of disinformation as well. I mean, these allegations that FEMA is out of money or that people in North Carolina are only going to get $750, that's the maximum. These are kind of deliberate lies on the part of a lot of lawmakers and politicians. That op-ed by J.D. Vance, I think, is pretty extraordinary in that it shows this real disconnect between what we're hearing from Republicans on the ground in North Carolina and Florida as well, that, in fact, the relationship between them and the federal government is actually quite good, that they're in conversation with national leaders, they're getting what they want, they're getting assurances they're going to get what they need, and yet you have this criticism from J.D. Vance, the vice presidential running mate, and others. So I don't think that there's a whole lot of truth to it based on what I've heard from those who are actually on the ground, seeing all of this relief effort put into place. But I think it highlights the fact that this is happening in this really extraordinary crucible. Yes, there have been these 2 storms, but also we're just less than a month away from the election. It has become a political thing, even if historically it hasn't been. And I think a lot of right-minded people would say it shouldn't be.
So let's talk about the politics. Biden yesterday was asked on his way out at the press conference about, does Governor DeSantis need to take Vice President Kamala Harris's calls? Biden didn't say yes. He basically said Governor DeSantis is doing everything and we're in contact with each other. And then DeSantis went on a bunch of news networks last night and said the same exact thing. Is Biden undercutting his vice president?
I think that the vice president is in this very tricky, I say tricky a lot, but a very tricky position in that the administration is trying to present this unified front. Joe Biden is still the president of the country, and he should be the one who's leading this effort. At the same time, with this situation, in the Middle East, she's kind of tagging on to all of these things. So if there's a call with a world leader, she's there having either a separate call or being party to that call as well. I think that's what's happening here, and I think that the criticism that she's getting from Republicans is not an invalid one. Why wouldn't you just speak to the principal, the person who's in power, the incumbent president at this point in time? Why would you speak to the vice president as well?
I guess the other issue, though, if she didn't call Governor DeSantis,
Absolutely.
the Republicans would say, well, why isn't she getting on the phone with this individual who's supposed to lead this incredible effort?
And indeed, that
it's
was the
gonna
criticism in the J.D. Vance piece as well, is that she was in California on a fundraising swing. All true. Is that something she should be criticized for if he is in contact with the president? I don't know.
All I can say is I share your frustration that this is political at all, because there are people on the ground who actually need help. And if they get it, that's great. And that's what people are looking for. I am wondering, though, not necessarily with the politics of the moment, but the logistics, less than a month out. These are swing state areas. These are the hardest hit areas. How do you get the infrastructure back up to actually ensure some sort of orderly voting system at a time where there is incredible focus on these states?
So both these states are working on it. Let's start with North Carolina, where you had the Board of Elections a few days ago putting into place changes in a number of these counties, more than 15 counties in the western part of the state where this is going to be an issue. So they're changing rules around being able to obtain an absentee ballot, where you might be able to turn that in, what the hours might be for that. We saw the legislature in North Carolina doubling down on that, making those codifying those changes yesterday. Then in Florida, we saw kind of similar flexibility put into place by the governor earlier in the week. We'll see if he does more. The real issue there is that registration closed on Monday of this week, and there's this push to reopen that in light of the fact that so many people had to evacuate. Were they able to get their registration done? There's now legal action in the courts to kind of get him to change that, but so far he hasn't.
We were just hearing from Bill Wadell of Accuweather that potentially this storm could cause something like $450 billion when put with the damages wreaked upon the area from Hurricane Helene. Is there enough money? And I ask this sincerely because maybe that FEMA hasn't run out of money, but there is a question of how do you pay for this at a time where insurers are on the hook for some of it? A lot of it's uninsured because people didn't think that it was necessary to get the insurance for their whole home flooding out in areas that were not in flooded zones.
I think that this is going to become an increasingly sobering story. And again, I think once the sun rises and we assess the extent of the damage, we're going to get a better sense of that. But what FEMA has said, what the White House has said is there is money at this point in time for FEMA to handle all of this, but will it be able to handle it in perpetuity? God forbid there's another storm. What would that mean? So I think it puts into stark relief what we've seen as kind of business as usual in Washington today, which is budgeting is broken. We had this stopgap funding bill passed that gave FEMA $20 billion for issues like this, but certainly not as much as FEMA asked for. There was a movement to get lawmakers to pass more additional legislation for more money. We'll see if that happens. But again, it kind of highlights the fact that planning is not done in any semblance of a medium to long-term way in Washington today, and that's a problem for this agency and for others.
Do you think Milton will be the impetus to get Congress back in session before the election?
I don't. And I hate to be cynical like that, and I'm not laughing at the circumstances.
What does it take to get off the campaign trail?
I know, and I think that, as we get closer to the election date, I think that becomes harder and harder to do. So again, I think there will be rhetoric about that. Where is Congress? Why aren't lawmakers doing more? But I think fundamentally at this moment, as we push ahead to election day, it's going to be very difficult to get them to do that.
Wouldn't they look better on the campaign trail to get back in session?
I have to go back to D.C. 3 million people are without power. People are underwater. We need to do something.
All I can say, as you said, what would it take to bring them back? I don't want to see it. If it was not this, I don't want to see what it would be to take to bring them back to their seats in D.C.
Yeah, well said. David, it's good to see you.
Good to see you as well.
Thanks for the update. Yeah. Thank you. David Gurr there of Bloomberg. One thing we do know, America can afford to fix it. A little bit later on this afternoon, $22 billion of 30-year bonds coming to market. I know you looked at the 10-year auction just yesterday.
Yeah, the internal is just a little weak. I mean, it was okay. It wasn't terrible, but it really just highlights how there is this feeling at some point. So I was speaking with Jamie Dimon. It's the reason why I was in London and not here for 3 days. And one thing that he said is, in some ways, he's worried that the Treasury market is going to become like the commodity market in the way that people will look at supply and demand dynamics as much as some of the other things that Brian Levitt was talking about, like the state of the economy. Essentially, people are going to be worried about the glut of treasuries that needs to be soaked up at each of these auctions. And we see that fear, we hear that fear, not really being expressed in yields.
Tiffany Wilding of PIMCO yesterday gave a nod to it. In her most recent research, this line jumped down. High budget deficits will likely persist, limiting the potential for further fiscal stimulus and adding to economic risks.
I mean, this to me is one of the big fears. Is there going to be a catalyst that causes some sort of reckoning in the bond market? So far, I got to say, the sort of question about how many people are going to wring their hands and worry about the deficit, it hasn't come to fruition.
And we talked to Tiffany about some of the policy proposals that are on the campaign trail. She's like, to be honest, that's just so slim of where the policy is. The CBO yesterday talked about where our budget deficit is right now. Topped $1.8 trillion. Why? Interest payments and, of course, Social Security.
There are trillions and trillions of dollars of promises on this campaign trail at the moment. Coming up next on the program, we'll catch up with RBC's Tom Narayan on what to expect from Tesla's robo-taxi event later on tonight. From New York, this is Bloomberg. Big 24 hours coming up for earnings. In the next hour, potentially the next few minutes, looking for numbers from Delta. Then on to tomorrow, we'll get numbers from JPMorgan and Wells Fargo. Into all of that, equity futures right now pulling back just a touch from all-time highs after posting the 44th record high of the year so far on the S&P 500 in yesterday's session. We're down 0.2% as well on the Nasdaq. On the Russell, the small caps off by around about 1/3%. In the bond market, 2-year, 10-year, 30-year, we had $39 billion of 10-year notes come to market yesterday. Bit softer than expected. The 10-year yield pushing higher, holding on to those levels this morning, 4.0785%. I said we'd get numbers potentially from Delta, and Lisa, we get those numbers from Delta right now.
They're seeing the fourth quarter adjusted earnings per share of about $1.60 to $1.85. Basically, in a range, the estimate was $1.78. When you take a look at passenger revenue, it's a little bit lighter than expected for the third quarter, $13.1 billion versus rounded up to $13.2. Nothing major. I want to look in here, though, to understand what the pricing of exact tickets are, what they expect for the pricing trends. Right now, their revenue for the third quarter, $14.6 billion versus the expectation of $14.65 billion. So basically a light miss. But what do they see going forward in terms of their pricing power is what people are going to be looking for right now. Investors not responding well to just even a slight miss for really one of the leaders in the airline sector.
The stock is just a little bit softer. We're down by a little more than 3% in the pre-market. We'll come back to that story a little bit later. Under surveillance this morning, Hurricane Milton moving off the coast of eastern Florida after bringing 85-mile-per-hour winds and heavy rain. The U.S. National Hurricane Center saying Tampa Bay could see a storm surge of as much as 5 feet of water, while Anna Maria Island could see 7 feet. The destruction, not just by the winds, but as we often say, by the water, is the one to watch now.
Absolutely. And this, obviously, Florida, the federal government have been planning for because they knew this was coming. They knew it was going to be bad. Right now, it's now moving off the eastern coast of Florida as a Category 1 storm, but the destruction is there. That photo of the Tampa Bay arena with the roof blowing off, this is supposed to be some of these infrastructure that's in place to withstand this. Absolutely devastating. And right now, more than 3 million customers in Florida are without power. So even if they want to call for help, it's going to be very challenging.
Did you guys see any of the simulations of what 5 feet of water would look like?
Yep.
What 13 feet of water would look like? And basically that it would just wipe out all the houses. You can't move back into a house that's been flooded like that without worrying about mold, without deterioration of the insides. Think about all the people who did not live on the coast, who did not buy flood insurance because why should they? It was going to cost them thousands of dollars a year, who now suddenly find themselves without a home. What happens to those people? And there are a lot of questions now, given the cost of the recovery. Who's going to pay for it and how many people are going to go through with it?
And how insurable some of these areas actually are, which is a conversation we'll have in the next hour or so. Let me get you an update on the latest from President Donald Trump, the former president, making a new tax cut promise in the final stretch before Election Day, vowing to end U.S. income taxes on Americans living in other countries. The pledge would reduce paperwork and potentially the tax bills for roughly 9 million Americans. Now, only one of us around this table has had to deal with this and deal with this every single year for a long, long time. AMH, how big is this for people living abroad as Americans?
Well, off the bat, it's a huge headache to have to file in dual areas. But depending on how much you make and how much tax you pay where you live, you might be exempt from U.S. taxes. So the United Kingdom actually has very high taxes, so then I didn't have to pay double tax in the United States. But say you're living somewhere else. Say you're living in the Middle East, a place like Abu Dhabi, where you don't have to pay some of that tax. You have to pay some tax back to the U.S. So for those voters, this could be huge. But the 2020 election showed that roughly 1.2 million ballots were sent and more than 900,000 of those individuals returned. The DNC, before Trump came out and did this, we're looking at 1.6 million voters abroad from battleground states. So it matters what states they're sending those ballots back to. Arizona, Georgia, Michigan, Nevada, North Carolina, Pennsylvania, Wisconsin. That's a big chunk of people.
Okay, that's exactly what I was going to say. This shows how strong the battle is for just specific individuals. I mean, you think about at a cocktail party what someone's complaining about. Yeah, I hate that I have to file taxes. Maybe I should renounce so I don't have to file taxes to the U.S. because I'm living in X country. And he's like, I hear you. Just put your vote in for me because I just need a couple more for this state. It just shows how narrow this is and that basically there are going to be no taxes if you keep going with this.
Relatively speaking, and unlike the other promises, this isn't a really expensive one. This comes down to paperwork. It's the paperwork as an American abroad that it's increasingly frustrating to do every single year when you have to file for American taxes as well.
It is, and to be honest, the first 2 years I didn't actually realize I had to do that. So then I had to go back, write this whole apology to the IRS, and I was like, oops, forgot about my paperwork. But I promise I paid taxes where I was living, and a lot of them. But what is the knock-on effect if this were true? Do people just start moving to the Bahamas? Does that become their primary residence and they count how many days a year they spend going in and out? Potentially.
The latest promise from the former president of the United States. Let's give you an update on the auto sector. BMW, Mercedes, the car sales from both of those companies slumping in China in the third quarter. Weak consumer sentiment driving down deliveries of BMW and Mini-branded cars by nearly 30%. Bramo, the steepest drop in 3 years.
All right, this comes after already pretty terrible news and them ratcheting down their forecast just with the European sales alone. This raises a question. I forgot who we were speaking to who said, never let a good crisis go to waste. This raises a question, can they make some of the overhauls that they need to structurally be in a better position going forward, given the competition from China and given what they have in terms of the landscape in Europe? And that's what I think people are frustrated about. What is that sort of restructuring? We don't even know what that looks like at a time where competition is growing and tariff threats just seem to be mounting.
The future of the auto industry could be very, very different. Tesla unveiling its highly anticipated autonomous taxi prototypes later on tonight. Tom Narayan of RBC raising his price target on the stock to 236 and keeping an outperform rating, writing this. We think robo-taxis could generate $1.7 trillion of revenues globally by 2040. And we'll see several players capturing market share, including fleet operators, app providers, car makers, and software developers. Tom joins us now for more. Tom, welcome back to the program, sir. Giant step back. Can we just spend some time from 35,000 feet? Can you explain to us how different this universe will look in 10, 15, 20 years' time?
Yeah, certainly. You know, today, the auto industry is about a $2.7 trillion industry. It's essentially a box with wheels industry with about 10% operating margins. The robotaxi industry will be about a $1.7 trillion industry, but massively more profitable, right? You and I, when we take an Uber, pay about $1 to $2 a mile. It only costs about 30 cents to operate one of these per mile. So it becomes a software business, a subscription-based business. And the multiples that these companies will trade at will be tech multiples. So I have Tesla at something like 250 billion out of the 1.7 trillion. But you apply a tech multiple to it, and now all of a sudden it's more than half of my entire Tesla valuation. So it dramatically increases the valuation of the mobility sector, the auto sector, because it gives all of us as consumers greater utility. We don't have to own a car, get chased by the cops, deal with parking, don't get into accidents. It's really a transformational thing for society. I'm sure we'll hear a lot about that tonight. It'll help solve the urban housing crisis, no more parking garages, etc. Really a breakthrough type thing for society. The real question, obviously, is when is this going to happen?
Well, let's talk about that, Tom. How quickly do you think we'll see this shift from consumers just pulling away from buying a single automobile and maybe buying a subscription to one of these services?
Yeah, I think this will be a very slow process. This is not years. This could even be decades. It will happen, though. We had Carlos Tavares from Stellantis at our conference a couple of years ago, and he said, you'll have to re-engineer cities entirely. He pointed out the example of the Champs-Élysées, where it's really a human decision of how to drive. And so cities will have to re-engineer themselves. Regulatory will be the big question mark that will and that's always a slow process. It will happen, but it will be years, maybe decades before we get kind of full ubiquity. But certain cities, you'll see it happen quicker than others.
Tom, I want to pick up on that. This question of the sheer technology of it versus the regulation of it versus the oversight, especially at a time where the host of data that you're going to need to make this happen, as well as the oversight and the potential manipulation of people's driving patterns, is going to become in cold relief when everything is a national security issue. How high are the hurdles? Do you have a sense of who's even working on trying to get some sort of regulatory framework and oversight into how this would operate, let alone whether it even could?
Yeah, I mean, I was at CES a couple of years back, and there were congressmen from, U.S. States who were speaking about this topic. So there is a political movement to get this happening, even in the U.S. It is a state-by-state issue in the U.S. But remember, we're saving thousands of lives, hundreds of millions of dollars in productivity, et cetera. So there is a political motivation to get it done. But obviously, you have questions about liability. Does the automaker get the liability? Does the person driving get the liability? So the U.S. is somewhat complicated. Europe, it's even more difficult to get this on the finishing line. You have the European Commission, which is a multiple countries, have to all agree together. We all know how difficult that is. China, however, is, I think, we're ground zero where this will happen. We're already seeing it happen. It's obviously central government can actually make this happen. So we'll see it happen in China quicker. My numbers have China with a much bigger robotaxi number than Europe or the US. Then it'll gradually happen state by state, I think, in the US. And then finally, we do think it'll eventually happen in Europe.
Tom, the person who's leading the charge here is a politically polarizing human being, Elon Musk, and he's making himself more so. And I wonder whether that puts Tesla in a better position or a worse position when it comes to still being the leader of the whole robotaxi movement in the future.
Yeah, I mean, you guys probably know that I can answer that question better than I can. But what I would say is I don't anticipate him doing something completely different than what we've seen already, at least near term, from robotaxi fleets from Cruise and from Waymo. I expect them to announce tonight a fleet service similar to that with their vehicle. Those programs already have approval, right, in the U.S. By those certain cities and states. I could see that being a similar path forward. But I do want to stress the technology that Tesla has with FSD is different. It is AI-based. We have it on the roads in Level 2+ in people's cars. It is very different, and it is better, quite frankly, than what a lot of Level 2+ on the road that we have. And there is an arms race for NVIDIA chips, and Tesla has quite a lot. So, over time, I think people will look at the kind of proof in the pudding and see, obviously, the data that will bear it out. We have to see the safety statistics and what happens. But, it's an arms race for GPUs. Tesla has a lot of them. FSD is a great product. There's a lot of people working in this company, not just one individual. I think we all have friends who work there who are very interesting and dynamic people. And it's a dynamic company. First and foremost.
Well, no one said Elon Musk wasn't dynamic, Tom. You're very optimistic when it comes to the long term. Can we really narrow this to the short term? This event is delayed by 2 months. How high is the bar for Elon Musk and Tesla this evening?
Sure. I've said that near term, I don't actually expect this to be a big catalyst for the stock. It had run into the event. We had a delivery number that was in line, and the stock still kind of sold off a bit. I think there was some folks who moved into Tesla because of all the carnage happening from the German OEM's profit warning. Never let a good crisis go to waste. I think I was the person who said that with you guys.
Thank you, Tom. Sorry. Credit.
Yeah, no worries. And so a lot of that happened, and basically, the stock pulled back. So it showed you that the stock ran into the event. So I don't anticipate a big up move, but I do expect that people like myself will finally get numbers on how to model robotaxis. I also think they could talk about Optimus, because on the invitation, it said "we robot." So I do wonder if we could hear more about Optimus. It's definitely not in people's numbers. So it could be a catalyst more longer term as we start putting these things, these higher multiple non-auto things in our models. We'll remember this day of in the future and look back, as opposed to tomorrow seeing the stock price, demonstrably higher or lower.
Tom, how strong do you think some of the hands in this stock are now, given that Elon Musk himself said, basically, if you don't believe in autonomous driving, don't hold this name? That was basically what he came out with in the last 12 months. How strong do you think the hands are in this name, given the rally we've seen off the April low?
Yeah, but I think people are starting to believe. If not starting to believe, they have been believing in the past several months. I mean, you can't get to a market cap close to whatever $800 billion just on a car business. It just doesn't work. The math isn't there. You have to believe it's a tech company. And autonomy is one of the only ways you can really get there. I mean, not even with energy storage, not with regulatory credits. Autonomy is a real software subscription-based business. People clearly giving credit for it based on where the stock is, right? So I actually think folks are believers in it. We just need details more than anything and not just PowerPoint slides. So we'll see the vehicle, I think, tonight. We'll see what it looks like. I mean, that in of itself is not going to get folks excited, but I think it'll give credibility that this is real and then this is happening and could happen. We could have a service maybe within the next 6 to 12 months.
We hope. Been promised that for a long time. Tom Narayan of RBC. Tom, thank you, sir. Appreciate the update. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. A quick check on Delta shares after just reporting earnings, down 6% in the pre-market trade. They reported passenger revenue in the third quarter that came in lighter than expected. Delta's disappointing forecast for profit and sales do point to a slower recovery from a tough summer travel season marked by oversupply of flight capacity. CEO Ed Bastian saying that the demand going into the year end looks strong, but Delta is bracing for a slowdown around the election next month. Apple is losing a key executive. Sources telling us that Dan Riccio is retiring. Riccio, a veteran executive and a vice president of engineering, reported directly into CEO Tim Cook. He spent 26 years at Apple and oversaw some of the biggest bets of the company. That included the Vision Pro headset and the failed bid to make a car. And one of the greatest athletes in history is calling it a career. In a post on X, tennis legend Rafael Nadal announced that he will be retiring at the end of the season. The Spanish icon helped define the sport's most dominant era alongside his peers, Roger Federer and Novak Djokovic. Aptly named the King of Clay, Nadal won a record 14 French Open titles alongside 8 other Grand Slams and 5 U.S. Opens, as well as an Olympic gold. The 38-year-old was ranked world number 1 for over 200 weeks, finishing 5 separate years as the world's top-ranked player. Nadal will play for Spain in his final match at the Davis Cup next month. And that's your brief, John.
Danny, thank you. Emotional morning for Rafa fans. I'm one of them. 22 slams. I think what we've witnessed is the greatest era in tennis ever. And I think it's fair to say possibly even the greatest era forever. When you look at the guys that were in this, the grace of Roger Federer, the mental strength of Novak and the competitive nature of Rafa Nadal. Rafa, for me, was number 1. I know that he's number 1 in slams. I know that's Novak, but for me, I think he always will be.
Grace and power. And it comes at a cost. I mean, when we feel old, when I feel old and like I'm falling apart, just think about what it is, what it does to your body to do that for 4 hours, 5 hours, the grace, the power. And so at 38 years old, all I can say is my hat's off to you.
It's one of those things that makes you feel old. Feels like only yesterday, the teenager on the clay of Roland Garros with a sleeveless shirt.
Yeah, the sleeveless.
Feels
Huge
like
muscles.
yesterday.
Yeah, although at the same time, it's nice to know that other people are human too. That's all I can say.
Just amazing. Congratulations, Rafa, for a phenomenal career. Up next on the program, the growing cost of hurricane season.
We're just seeing rapid intensification that we haven't seen before in history. Insurance markets are no longer able to provide affordable or available insurance due to these increasing impacts. I don't know if we have answers for that yet.
That conversation up next, live from New York City. You're watching Bloomberg TV. How high is the bar this earnings season? Delta out just moments ago, the midpoint of guidance. Missing estimates. The stock is down, Lisa, by 6%.
Because basically what they're talking about is that they're not immune to some of the price pressures going forward. They are trying to reduce supplies so that they don't have to deal with the glut of seats. But Delta was the top tier of all the airlines. They were supposed to be more immune to this than the others because of their high-end customer. They are not. And that's, I think, why the shares are being punished. They've already gained. They're also the first to report. So basically, they're ripping the Band-Aid off of what might be a pretty difficult reporting season.
Setting the tone for the industry this morning, that stock is down by 6%. Under surveillance this morning, the growing cost of hurricane season.
We're just seeing rapid intensification that we haven't seen before in history. Given the size and impact of what Milton looks to do, I would imagine there's going to be a lot of people redeployed across the nation to support the state of Florida. As the insurance markets are no longer able to provide affordable or available insurance due to these increasing impacts, we're seeing this transfer of risk to the taxpayer, and that's going to grow, and I don't know if we have answers for that yet.
So here's the latest. Hurricane Milton sweeping across central Florida with wind speeds topping 80 miles an hour. The storm leaving more than 3 million people without power. Matthew Palazzolo of Bloomberg Intelligence writing, Hurricane Milton remains on track to generate insurance claims in the tens of billions, with economic losses a multiple of that amount. We expect a wider than typical gap between economic and insured losses, similar to Hurricane Helene. Matthew joins us now for more. Matthew, welcome to the programme. Just talk to me about that gap, the gap between economic and insured losses, and how much wider that gap's going to be in years to come.
I think it's going to get wider and wider for years to come. What you're seeing is home insurance companies, they don't cover storm surge and flood, and for good reason. And what you're seeing is that is an increasing peril in these things. Hurricane Helene, Hurricane Milton here as well. So the economic losses, they can also include things like business interruption, but those will be, typically it's like half. And I think in this case, it could be like 3x.
Given that, who's going to get stuck with the bill?
So the taxpayers are going to get stuck with a lot of the bill on the flooding. There's a federal program, the federal flood insurance program, and then the local market in Florida is subsidized by those taxpayers heavily. The biggest home insurer in Florida is the state.
Florida has 9 new insurance companies. Do these companies stay there after this?
So what had happened is this company that I'm talking about called Citizens, they made a big effort to depopulate. So they made a big effort to try to get private companies to take these policies. And it was kind of successful. I will say this storm, from an insured loss perspective, did avoid a worst case. So if we had that worst case where people are talking about $100 billion, then I feel like a lot of those companies may have left or gone bankrupt, but they're probably okay.
If a lot of the recovery will be funded by domestic and local taxpayers, will Florida, famous for their low taxes, have to raise taxes?
It's possible. I mean, I don't get into state government activity, but the insurer, Citizens, has the ability to assess insurance companies in the state. So they can, if they can't pay the claims, which they should have the claim paying capability to do this, but if they couldn't, they would assess the insurance companies, which means the insurance companies would then raise prices again. And obviously, the insurance in the state is incredibly unaffordable as is.
Hurricane Helene was a wake-up call for a lot of people who figured out that previously areas that thought they were untouchable can be touched and can be hit very hard by this. Do we need to rethink who's vulnerable and who isn't across this country now?
Yeah, I mean, the federal flood insurance program is revamping its pricing and its models, but a lot of those models were from the 1960s and 70s. So we've not understood the flood risk well. The National Flood Insurance Program had this pricing system where they updated it last year, and 70% of the people in the program saw their prices go up because the prices were so inadequate. Even said, the home insurance industry, even excluding these losses, doesn't make a ton of money. It's not a super attractive business regardless. So if you were to try to put that on top of it, it would make it an even less attractive, less positive ROE business.
Things have changed a lot. Matthew, appreciate the updates. Good to see you. Thank you. Matthew Palazzolo there of Bloomberg Intelligence. Up next on the programme, the second hour of Bloomberg Surveillance looks a little something like this. We'll catch up with Dan Greenhaus of Solus Alternative Asset Management, the Florida CFO, Jimmy Patronis, Holly O'Neill of Bank of America, and Claudia Sahm of New Century Advisors as we count you down to CPI in America. That data drops at 8:30 Eastern Time. Equity futures going into that just a little bit softer. We're down 0.2%.
There's a lot of potential earnings upside ahead.
I'm probably more inclined to be adding risk than reducing it.
There's an opportunity cost to being underweight risk assets more broadly.
Overall trend of the market is still quite good as well from a technical perspective.
These markets are priced for perfection, but that's because the backdrop is quite nearly perfect. The question is, can it last and where does it go from here?
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
It is CPI Thursday, that economic data 90 minutes away. The scores going into it this morning. Good morning. Look like this. Equity futures on the S&P 500 down by 0.2% after posting the 44th all-time high of the year so far in 2024. In the bond market, we hold on to 4 on a 2-year, a 10-year, a 30-year. The front end of the curve yields higher by almost a basis point. 4.03% at 8:30 Eastern, Lisa. It's the main event.
Yeah, we've got CPI and whether we get a feeling that inflation truly is decelerating quickly enough. You said something earlier that I thought was really important, which is the bond market hasn't proven to be a problem for this equity market. If the bond market was going to be a reason for worry, one of the many that we hear about from people that's not being actually implemented in any sort of selling, then it cannot be right now, given how much of a sell-off we've seen there and the fact that we just had the 44th record high with credit spreads on investment-grade bonds, the tightest going back to 2021.
I can't get over the fact that CPI is actually important today, given how everyone was really just writing it off before the blowout jobs report. Bloomberg Intelligence says they think core print will actually be more robust than consensus expectations, but seasonal factors for the remainder of the year make it difficult to sustain deflationary momentum. So what does it look like from here to the end of 2024?
Jobless claims one to watch as well at 8:30 Eastern, and then we can get our teeth into the earnings out of Wall Street from JPMorgan and Wells Fargo tomorrow morning. That'll be Friday's story. Earlier on this morning, Delta coming in just a little bit softer than expected in the pre-market, Lisa. That stock is down more than 6%.
Yeah, and it shows that the bar, you were asking how high is the bar? Pretty high, because they basically were in line, just slightly below expectations in terms of their forecast, but still showing revenue growth, still expecting to see that revive after a sort of sluggish period. A real question about overcapacity, how much they were going to bring back so that they didn't have to discount seats so much. Marginally, they're getting there. And oh my God, sell, sell, sell. You know, is this just because they had actually done pretty well, or is it just that expectations are a lot higher than we might have otherwise thought?
You said it earlier this morning. First name out of the gate for the industry, setting the tone for the industry in a pre-market going into the up and about. Setting the tone for the next 60 minutes, here's the lineup for you. Dan Greenhaus of Solus Alternative Asset Management ahead of CPI data. We'll speak to the Florida CFO, Jimmy Patronis, on the aftermath of Hurricane Milton, and Claudia Sahm of New Century Advisors on why she says the US job market is in the twilight zone. We begin this hour with stocks holding steady after posting the 44th record high of the year so far. Dan Greenhaus of Solus Alternative Asset Management saying the stock market still looks good to me. Broadening gains are encouraging, and despite all the worries over everything, market cap and equal weighted indices are each essentially at highs. Dan joins us now for more. Dan, good morning.
Good morning, sir. How are you?
It's good to see you. Why do you always act surprised?
Because I'm not listening to start.
Thanks. You're listening now?
now that my name has been called.
Live on TV. Good. It's good to see you.
Dan.
Look, equities at record highs. Credit spreads are incredibly tight. I think we should start in credit.
Sure.
When you look at credit right now, how tight are things at the moment?
Yeah, listen, they are, I think, depending on your index, you're effectively at all-time tights. I mean, that's not exactly true. If you use the JPMorgan index, for instance, their IG index is called 10 or so basis points away from all-time tights. The high-yield index is 90 basis points away from all-time tights. Bloomberg obviously has an index that's similarly close to all-time tights. But I don't think in that sense the credit market tells you anything that the equity market is not. We're obviously, as we've discussed and you discussed with other guests, pricing in, for lack of a better word, a soft landing or just a continuation of the expansion. And risk assets in general are appreciating in that type of environment.
Is it sufficient that they're even talking about interest rate cuts? Is that just good enough? The fact that we've got this backdrop for growth and we've got a central bank that's even having a conversation about lowering interest rates more?
Well, to state the obvious, we're not just having a conversation about it. We've already realized a 50 basis point reduction. We're probably going to realize 2 more 25 basis point reductions this year. There's obviously a debate about whether that's completely necessary or not, but from a expected value standpoint, that's probably should be your baseline. And so we're not just discussing it, it's happening. And so the more important thing for risk assets is not whether rates are going up or down, it's what's the broader economic and earnings backdrop. And in that sense, yes, rates are coming down, and that's an added benefit, certainly for companies that have to refinance and the maturity wall in the credit market, et cetera. But ultimately what matters is that cash flows still look pretty good and the economy still looks pretty good. And so from that standpoint, why shouldn't risk assets appreciate?
There's a question about whether the bond market, treasury market in particular, is increasingly kind of dancing to its own music. As long as good data comes out, even if yields go higher, it doesn't really matter for risk assets. At what point is that sort of a threshold that gets crossed as yields continue to grind upward?
Well, I think it's also important for investors to remember that the relationship between yields in the treasury market and risk assets is a moving target. And in particular, in the post-2000 period, roughly, higher yields, which are associated with higher growth and not necessarily higher inflation, have been a positive for risk assets. They can move in tandem. And I think you had a period of time, obviously, where inflation was spiking, where that relationship was inverted. people were concerned about inflation. But as we've moved now towards growth concerns, right now, I think higher yields are not necessarily a problem for the equity market in the sense that if they are corroborating the idea that the economy is continuing to grow, maybe the Fed, a lot of what's happened, obviously, is the Fed can't cut as much as was originally priced in, stupidly, I might add. But in that environment, why wouldn't equities appreciate, even if the yield in the 10-year goes from 3.50 to, let's say, 4?
So to pair that with credit, is Solus thinking that structurally credit spreads are going to be tighter this time around relative to the higher benchmark yield, simply because the higher yield reflects how good the momentum in the economy is, which should, all things being considered, make a lot of the companies who even are lower rated look more creditworthy?
Yeah, no, that's 100% accurate. I would also add, and we've discussed this in the past, this is not your mother's credit market. It's a more highly, I don't know that
my mother had a really, really impressive credit market.
But I mean, it is true that the market is more highly rated. You have a higher proportion of debt at the top of the high yield structure than at the bottom. Companies have higher cash and lower debt to EBITDA ratios, leverage ratios. So there's all sorts of reasons why the market should be, in a sustainable way, tighter than what we've seen historically. And in conjunction with that, you have, to your point, the better economic backdrop, which improves the environment. Defaults are relatively constrained. So all of that together makes for a more attractive credit market and should, over time, obviously if you have a recession, this changes, but over time should support higher valuations in the credit market as well as the equity market.
Given everything we've said, what's your advice to people who have missed out on all of this and they're sat in cash? What do they do? Stocks at all-time highs, credit spreads very tight. Where do they go?
This is like the Sasquatch. I don't think those people exist.
You don't think they exist?
No, I don't think they're...
I know some personally.
Tell us what you mean.
Well, Lisa might know one person who has sat in cash for some time.
I think it's Lisa for what it's worth, but carry on.
But I don't think
Move on.
I don't think after a bull market, so to speak, in both equity and credit that has lasted this long, has not sucked in most investors at this point. And I think you're at a point in the cycle now where I don't think we should be having the conversation, is it a bull market, is it about to end, et cetera, et cetera. I think the conversation now should be considerably more nuanced than has been for some time, in the sense that, okay, things are doing okay, risk assets continue to appreciate, where's the outperformance going to come from? Is it still tech stocks? Should I rotate into energy? Is it defensives? What factors should I be overweighting, et cetera, et cetera? Where in the capital structure should I be positioned? Triple C's have had a very good year. Obviously, that's not a market so much as a bunch of idiosyncratic names, but those are the types of discussions that asset managers have all the time, but I think for a lot of viewers out there are watching should be happening to a greater degree today.
When you say that money doesn't exist, you're not saying that money's not real. You're just saying that that's not the kind of capital that's going to get deployed to risk.
Which money did I say doesn't exist?
Money market funds.
Oh, the $6 trillion, yes.
Sure.
No, well, listen, listen, this is a favorite topic of mine. That $6 trillion exists, but I think people come on television and write notes and talk about it as if it's this monolithic item which is going to spur equities higher as the cash goes from $6 trillion to $2 trillion. That's not how it works. First of all, a portion of that money is institutional, a portion of that money is retail. Some of it's in tax advantage funds. It's not like they're all comparable to NVIDIA. But the most important point I would make, and I've made repeatedly, and I will do it until I die, that $6 trillion needs to be scaled for something because number go up. So you can't compare today's $6 trillion to $6 trillion 5 years ago. What do you compare it to? My preference is the S&P market cap. How much is on the sidelines compared to the market cap? So let's do the math real quick. There's $6 trillion or so of money in market. There's $6 trillion of cash or so in money markets. Let's treat it like it's a monolithic total. Equity market cap, the S&P 500 is called 50 trillion or so. So that's, 10, 12, something percent of the equity market cap. That's not out of step with what we've seen over the last 10 or 15 years. Yes, there's a lot of money on the sideline, but as a share of buyable assets in the S&P 500, if that's your argument, it's not necessarily high. That's not to say that it will not come down. It will. At some point, $6 trillion will go to $5 trillion, and some of that will go into the equity market. But do I think that is a reason for me to be even more bullish or bullish at all? No, I don't think so.
I can tell you that was such a much better answer than the first one.
What
doesn't exist?
Well, all I can say is, I love this. We should come up with clips.
I must have had a Will Ferrell moment.
Okay,
I don't remember saying the $6 trillion doesn't exist.
It's sort of a theme this morning, Dan.
Okay.
Honestly, to me, this we should get clips of everyone saying money on the sidelines is a reason to buy, and then all the people saying money on the sidelines is a fiction. Stop it already.
Next time.
Okay.
I'm sorry. Go.
Okay. I am curious. I do want to get to this because Solus really specializes in distressed investing. Right now, the world that you just pictured, no distress there. What do you guys do?
Well, listen, distressed managers have been wrestling with this for many, many years, and I don't think Solus is any different in that regard. That is to say that when you the traditional distressed manager in previous cycles probably doesn't exist much today. Solus does as much investing up the capital structure these days as we do down the capital structure. So we're capable and have owned, not Visa, but like we could own Visa and we could own Dish unsecured bonds. And when you have an environment like we've had for some time where the Dish unsecured bond equivalent is few and far between, as has been the case these days, there's not so much workouts, there's not so many restructurings. You have to find risk-adjusted returns elsewhere. And we've done that increasingly in the equity market and up the capital structure. And I think that's been rewarding for us over the last few years. I think we're pretty pleased with our performance. The way that I talk about it is we're taking what the market gives us. We're not. There might have been a time where we were trying to force the issue and saying distressed managers, multi-billion-dollar distressed managers, this is the only sandbox in which we can play. We've traditionally played in that sandbox. We must stay there. I don't think we have that view and haven't for a decade. We're all over the capital structure, and I would argue justifiably so.
Are distressed hedge funds being made out of business by some of the big private capital funds that are out there doing a lot of rescue finance?
That doesn't help, but I think the bigger issue for distressed investors in general is there's just not been very much distress. The maturity wall, which everyone keeps talking about, hasn't been binding. Restructurings get done, and the lack of covenants in the loan market and elsewhere make it easier for companies to go longer before they enter court restructurings. And when they do, there's fewer assets to fight over, which gave birth to LMEs, but this whole separate conversation. But yeah, listen, again, I think we're finding stuff to do. We've talked about the energy market. Oil is $20 off its highs, but a lot of those stock names are basically at highs. We talked about the consumer ad nauseum on here. There's any different number of ways you could play the consumer. We've talked about cruise lines. We've talked about in the media space where Solus has a history. It's well known that we were a large holder of MGM Studios, so we have an expertise in that area. There's stuff to do there. I don't think there's any shortage of stuff to do, again, if you don't sit here and say that's the only sandbox in which we can play.
Dan, this was great. It's good to see you.
My pleasure as always, guys.
It was
Thank
real.
you.
It happened. Dan Greenhaus of Solus Alternative Asset Management.
I'm going to have to watch the tape.
Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Eli Lilly is ramping up its legal campaign against companies that were temporarily allowed to sell copycat versions of its blockbuster weight loss drug. Lilly is sending hundreds of cease and desist letters to telehealth companies, pharmacies, and medical spas, demanding that they stop selling their products. The FDA had deemed Lilly's drug in short supply about 2 years ago, allowing compounding pharmacies to mass produce copies. When the FDA removed the shortage designation earlier this month, compounders lost that permission. The Wall Street Journal reporting this morning that TD Bank is facing penalties of around $3 billion and restrictions on its growth in a settlement with U.S. regulators. They found that the Canadian bank failed to catch instances of money laundering and other financial crimes at several branches in New York, New Jersey, and Florida. Additionally, the U.S. Treasury is expected to impose a cap on TD's retail banking assets as part of the agreement. And sky-high resale prices for Oasis tickets have Live Nation's top executive calling for a change. During a Bloomberg conference, CEO Michael Rapino said that multiple billions of robots targeted the band's upcoming tour when tickets went on sale. He's urged government officials to regulate the business by capping ticket resale prices at a 20% markup. Live Nation is currently facing an antitrust lawsuit from the Justice Department, but Rapino believes that Live Nation will win that case. And that's your brief, John.
Danny, thank you. So the people buying Oasis tickets didn't actually exist. Robots.
Exactly. And that, I think, is going to be a key problem. Actually, I hate that about resale values, that if you don't get in on it, if you don't, it's basically like an allocation for a big bond offering that everybody wants.
Totally agree.
Yeah.
Robots or Dan Greenhaus, he does not remember. Up next, brace in for Milton's impact.
You need to prepare for catastrophic impacts. This is going to be a serious storm, one that could forever change communities that are still recovering from Helene.
The latest on Hurricane Milton up next on the program, live from New York City this morning. Good morning. Live from New York City, welcome to the program. Equity futures on the S&P 500 just a little bit softer. We're down 0.2%. under surveillance this morning, bracing for Milton's impact.
You need to prepare for catastrophic impacts. This is going to be a serious storm, one that could forever change communities that are still recovering from Helene. 2 massive storms have come our way in only a matter of weeks. But this is what we do. FEMA is ready. We are here to help people. We are here to save lives. And that is exactly what we are postured to do for these incidents.
So here's the latest this morning. Hurricane Milton battering the Tampa Bay area with heavy rainfall and 85-mile-per-hour winds after making landfall as a Category 3 storm, leaving over 3 million homes and businesses without power, according to Power Outage US. Joining us now is Accuweather's Joe Lindbergh for the latest. Joe, thanks for joining us this morning. What is the latest? Where are things at?
Jonathan, the worst of the storm is pretty much over with. The center of lowest pressure is now east-northeast of Cape Canaveral, Florida, and it's moving east-northeast and out to sea. There's still a couple of rain bands that are affecting the eastern portions of the state. Those will take another couple of hours to move offshore. Once they do, the worst of the rain will be done. Unfortunately, with all of the rain that we've seen over the past 24 hours, upwards of 18.5, 19 inches in the St. Petersburg area and a foot or more across the central counties of the state, there's flooding that's going to take days to recede, if not weeks.
We said it before, we said it again. It's the 1-2 punch no one wanted to see. Joe, we appreciate the updates, sir. Joe Lindbergh there of Accuweather. Hurricane Milton following Hurricane Helene. Joining us now is Florida CFO Jimmy Patronis. Jimmy, welcome to the program, sir. Thanks for taking the time. I think top of mind for you, for all of us, search and rescue. Walk us through how well prepared we are, how things are looking.
So we have 1,600 urban search and rescue first responders out all over the state of Florida right now. Teams were deployed last night into St. Lucie County. That's where we had all of the tornadoes that were spun off the backside of the storm. I know there was a lot of fixation on landfall, but the tornadoes off the backside are what really that caught a lot of our citizens off guard. Almost 30 tornadoes have been tracked, 128 warnings. So as those resources were waiting for sunrise today, we have got, look, it's hard to hold these men and women back. They're out there doing their jobs, even as the storm is still in the state of Florida.
Jimmy, what's going to be the biggest concern this morning?
So we want to get our citizens to take their time going back to their homes. I know everybody's been traumatized, those that had evacuated. Look, let our first responders get the community stabilized. There's down power lines. There's going to be broken utility lines. There's going to be intermittent cellular service. So if you're somewhere safe and comfortable, take your time. Be there, go into 24 hours, 48 hours. Let the dust settle, because right now bringing a bunch of individuals back into their communities as their communities have not stabilized is just going to create for a longer duration of recovery.
So there's going to be a period of time where people are displaced, and then they're going to come back, and there's going to be a real question about rebuilding some of these areas, just how much damage there has been done. We were speaking earlier with Bill Wadell from Accuweather, and he was saying that the first storm, Helene, probably caused somewhere between $200 and $250 billion in damages, not just in Florida, and that this one could cost something sort of in the same range. How are you prepared to manage all of this as you rebuild?
Well, the big difference between what happened in North Carolina and happened in Florida, Florida carries insurance. In the case of the state of North Carolina, Asheville alone only had 248 flood policies. But most people would think, why do I need to have flood insurance while I live in North Carolina? So in the case of the state of Florida, we're much better covered. We have much more of an insurance blanket over the state of Florida. So, again, there will be challenges, there will be rebuilding, but to me, nobody does recovery better than the state of Florida. And this is what we'll do. We will take one foot in front of the other, and we'll continue to build back our cities and our communities.
Jimmy, of course, there will be some residents worried about their property taxes, worried about their finances. With the experience of Hurricane Ian, can you just walk us through, for the people who aren't aware of this, how the rebate system actually works down in Florida?
Well, I think the reality that people have to let sink in is look, it costs more per square foot to build a house today than it did 5 years ago. So the cost of construction is going to change when it comes. So some people will be underinsured. Some people will sell their homes as is. They'll cash out. They'll move into another community. When Hurricane Michael hit my hometown, my neighborhood, everybody had aged out. So what a lot of them did is they cashed out, took their money, and they move closer to their grandkids or their kids. So again, this will be some of the similar type of response we'll have of this. St. Lucie County, where one of the tornadoes hit, was a retirement community. I'm sure a number of those families will probably look at other alternatives as they receive a large payout from their insurance company, and they may just decide to pick a different place to live closer to family.
Jimmy, do you think that just in general, there is going to be kind of a migration in Florida away from some of these areas that have gotten hit, as you said, as people age out, decide to shift elsewhere?
On the contrary, it's amazing the type of land rush that takes place after a storm. You will have all of those that saying, you know what, again, I've aged out, I'm going to move out, but there are people lined up down the street and around the corner that will buy back in those coastal communities. They will build up, they'll build to the higher building codes, and they will make the necessary investments to be able to enjoy what's beautiful about living on the Gulf Coast or the Atlantic coast. But you would think that, but it's amazing the type of land rush that happens immediately after a storm.
Jimmy, before the storm hit, you said the path it was going on could be something of $10, maybe $20 billion worth of insured losses. Did the path follow what you were expecting?
I wouldn't be surprised if the number exceeds that. We saw with Hurricane Ian, we saw almost 800,000 insurance claims, over $20 billion in insured losses. We did not have a type of an impact into a densely populated market like a Fort Myers and Naples did last time. It went into Sarasota, still heavily populated, but it's not going to be, in my opinion, as impactful to that initial area. So now this storm crossed through Orlando, so it's still yet to be determined how much damage Orlando suffered for this, because again, Orlando is going to still receive 18 plus 10 to 12 inches of rain, and this is flash flooding. So, those communities in Orlando, hopefully they learned from Hurricane Ian. It's important to have flood insurance no matter where you live in Florida. And sometimes we have to learn the stove is hot in order to respect it in the future.
Hey, Jimmy, we respect you, sir. Thanks for your time this morning. Our thoughts are with you and the people of Florida. Jimmy Patronis there, the Florida CFO. The demand to live there. Did you hear that? That's what stood out for me there.
Yeah, at first I thought maybe people are saying we're not going to rebuild if it gets hit quite a bit, and instead it's quite the opposite, and there's a land rush. At a certain point, you do wonder exactly how the rebuilding is going to get financed. From a market perspective, you do get the sense people are kind of saying, if anything, this tends to be stimulative, because actually it ends up to spurring more spending. At some point, how does this get paid for, though, on the other side is sort of a key question.
A land rush. People want to go back. They want to rebuild their homes. And that's why there was so much concern from some people to actually heed those calls to evacuate and leave, because they wanted to protect their property. You have to think the cost of this. He's talking about maybe north of $20 billion just in uninsured losses.
There is going to be a huge rebuild effort following Hurricane Helene and then Hurricane Milton overnight. Up next on the programme, we'll catch up with Bank of America's Holly O'Neill on their latest consumer report. Look out for that conversation on the other side. From New York, equity futures just a little bit softer. CPI data a little more than 1 hour away. Earnings season picking up. We heard from Delta a little bit earlier this morning. You'll hear from JPMorgan and Wells Fargo tomorrow morning. Equity futures right now pulling back by 0.2% on the S&P 500. Delta in the pre-market down by more than 6%. The midpoint of the guidance, missing estimates. This one must have been a high bar because this one's getting punished.
Yeah, it came in below estimates in terms of the midpoint of the range that they came out. But there's also this. The revenue growth guidance came in at about 2 to 4% versus the 4.4% year over year expectation that was expected by analysts. The point here is Delta is the best of the best when it comes to resilience at a time where the lower income consumers are pulling back. And if they're having problems, what does that say for the rest of the industry?
Pulling down the rest of the group this morning, going into the opening bell. That's the story with equities. Here's the story with the bond market. Brief look at the picture for you. A snapshot, the 2-year, 10-year, 30-year. You'll notice one number down the left side. 4s and not 3s. Big change since we got payrolls last Friday. A blowout jobs report. Will we hold on to these levels? At least they're going into CPI 1 hour from now.
Yeah, does CPI matter, right? Basically, have we got enough of a sell-off where any kind of upside surprise will be tolerated just fine, and a downside surprise could bring in some buying? A real question here, can we ignore inflation? the way that the Fed seems to be doing so. We started off the show with Brian Levitt saying, yes, you can. We talked about that with other people. They say, no, you can't. So we shall see at 8:30 a.m. this morning.
We won't be ignoring it at 8:30 when it drops. Let's turn to foreign exchange. I want to finish on this. Just want to watch through to the close today. DXY, the dollar index, through yesterday, 8 consecutive days of strength. That is the longest winning streak going back to April 2022 when we had 9. We're looking to see if we can make it day 9. The dollar index this morning just about unchanged. Under surveillance this morning, more than 3 million people across Florida are without power as Hurricane Milton barrels across the state. The National Hurricane Center continuing to warn residents of life-threatening storm surge, damaging hurricane-force winds and heavy rainfall.
Absolute devastation. When you look at these photos coming out of Florida, we're going to get an update from Florida Governor Ron DeSantis in about an hour's time. We heard from President Biden last night talking about the fact that they're basically pulling on every lever they can. The Department of Defense will be ready to provide active duty service members. Governor DeSantis talking about officials and law enforcement officials coming from outside the state to help them, and just the immediacy of making sure people are safe. And then, of course, it's that rebuild effort and the billions of dollars this is going to cost.
Expect plenty of updates throughout this morning. As we get them, we'll share them with you. An update on the latest in the Middle East. President Biden and Israeli Prime Minister Benjamin Netanyahu holding their first call in more than a month. Biden continuing to warn Israel against attacking Iran's nuclear sites in retaliation for last week's missile barrage. Israel's defense minister still saying they will carry out a deadly hit.
The Wall Street Journal has some insight into what's going on between Jerusalem and Washington. They say Israel has so far refused to divulge to the Biden administration details of its plans to retaliate against Tehran. You only have a readout coming from the White House about what happened on this phone call. Karine Jean-Pierre said it was very frank. They haven't spoken since August. You could feel that they're potentially not on the same page right now when it comes to what Israel is going to do. And we don't know yet what Israel is going to do. We do know the United States, though, doesn't want them to hit nuclear facilities. And we definitely know they don't want to hit Iranian oil facilities as well.
There's a question about how much clout President Biden has in the sort of last stages of his presidency at a time where Netanyahu has aligned himself more with Trump than the Biden administration and Kamala Harris, basically thinking that if he can withstand this, he has more free reign because no one's going to even try to rein him in later on. So that's sort of one overhang to this entire situation.
This story has whipsawed the commodity market over the last week or so. We are firmer this morning on Brent by 1%, 77.50 on Brent crude. WTI 74.14. Let's get you some Fed speak. San Francisco Fed President Mary Daly expecting 1 or 2 more quarter-point cuts this year as the central bank looks to protect the labour market. The minutes of the Fed September meeting showing there was debate about how far to go, with some officials preferring, Lisa, a 25 basis point rate cut.
Didn't you say something earlier? You said something like it isn't a one-mandate Fed. It is a one-man Fed. It was Fed Chair Jay Powell basically pushing everyone, look, we should have gone in July. Just get on board. We're going now 50, but it's not going to basically mean anything. And that's the tone that you've heard from so many different Fed officials, one after the other, whether it's Mary Daly, whether it's Lori Logan saying a more gradual path back to a normal policy stance will probably be appropriate from here. Susan Collins echoing that. John Williams basically talking about that as well. Even Neil Kashkari. So where is the super hawk that's going to go by 50 basis points as a de facto move going forward?
Basically, what the minutes have confirmed is what we've been speculating around this table for weeks, which is the fact that Powell was the one to nudge everyone along. And now in the blackout period, if potentially he has a change of mind, you need to make sure you're reading some of the pieces in the Wall Street Journal and the Financial Times, right?
Colby Smith, the FT. Stay tuned. Stay tuned. We're all going to be doing the same thing in the next couple of weeks. Let's turn to the state of the US consumer and consumer spending. The Bank of America Institute publishing its latest consumer checkpoint just ahead of CPI due out in just under an hour. The report pointed to modest forward momentum, with spending relatively steady as wage growth remains supportive. I'm pleased to say that joining us now is the Bank of America President of Retail Banking, Holly O'Neill. Holly, welcome to the programme. We've got a lot to get through. I always say this every time we cover this report. It's one of my favourites to get a clean read on what's happening with the US consumer. I think looking at the latest Hurricane Milton overnight and Hurricane Helene before that, can you give us an understanding of what card spending looked like in the states that were impacted by those weather events?
Sure. So spending in September, what continued good, positive momentum, as you said, but we did see a drop in spending as we saw that last week in September with the impacted areas of Helene. So spending for the consumer did come down in the impacted areas, but it was relatively small overall when you look at the whole U.S. consumer across the U.S.
We've been covering your story for a while. Median balances of consumers so much higher than they were pre-pandemic. There's another big bank balance, and it's called a house. And as rates come down, Holly, we're trying to work out how many people are going to tap home equity lines and what they'll be doing with that money. How much of that activity have you seen increase over the last month or so?
Sure. So there is undoubtedly value in homes, right? And you see that in home equity. But that value is skewed to the higher end. Not everyone owns a home. Not everyone has equity in a home. So as you read through the Institute report, you'll see some differences of opinion of what we could see there. I think there is some skepticism that home equity could really drive spending, given that it's only a subsegment of the population. And so we'll watch to see what happens. We have not seen a big jump in home equity spending to date. And I think there's some skepticism as whether that will really drive consumer spending as we move forward.
Holly, I love the fact that your report kind of puts some texture around choiceful and choosy and selective and some of these words that we hear from some of the CFOs and CEOs of retail companies as they deliver them on earnings. Is it basically we're not going to buy a refrigerator, we're not going to buy a stove, we're not going to fix our car, but we will go out fancy dinners? Is that basically what you're seeing?
That's exactly what we're seeing. So washers, dryers, dishwashers, those are not flying out the door. So the high-end durables still are very controlled from a spend perspective. Where we do see spend is in the experiences, and services continue to be strong. And I think we're still seeing the impact of the high durable spend that we saw through the pandemic, and that will work its way through. But you're exactly right.
Given this texture, Holly, there were a lot of questions with the labor market report that we got last week on Friday about whether it checked out through other forms of data or whether it was sort of a blip that was going to get revised significantly. How much do you see almost confirmation of the increases in wages and the continual employment of America through the consumer data that you're seeing?
Well, I think the wage growth and the labor market is supporting the continued spend. So, that spend, the forward momentum is still positive, right? It's slowed since the end of the pandemic. We saw a rise as the pandemic came to a close, a significant rise. And so that spend is still positive and it's good forward momentum. And I think that is supported by the wage growth and the strong job market.
When you see this spend, especially the persistent spend on services, is this across all income cohorts?
It is. So we see similar trends no matter what income cohort, high end or low end. Of course, in the high end, high income cohorts, you see more spend, but in the lower income cohorts, you still see the strong spend. Within the data, you do see them making some trade-offs with value, more white label spend perhaps, but it's strong throughout.
So when you look at services, is it going out to eat? Is it going on holiday and vacationing? Where is the money going towards?
It is across the board, going out to eat, although I will say within restaurants, we are seeing some shifting to more affordable restaurants versus very high end, but the spend in the category is still strong. We are still seeing spend in travel and experiences. So there is real consistency that we've seen here.
Holly, there are some people who are looking for something to worry about. A lot of people are looking for something to worry about, especially given how high equity market valuations have gotten and the fact that one person after another comes on and says, I just don't see it. Is there any evidence, anything that you're seeing in this report that gives you pause or that's something that you're watching?
There really is not. I mean, we are seeing and watching very closely that spend pattern and where consumers are making trade-offs. But I think those trade-offs are really good, right? They're looking forward. They're making some adjustments in their spending so that they can continue down a path of strength. And that's further supported by the job market and wage growth. So there really are no real problem areas underlying our data that we're seeing. And consumers still have a cushion in their deposit and savings accounts as you compare it to pre-pandemic. So that's another good sign that the consumer remains stable.
Ollie, can you build on that just a little bit more? Tell us what the median balance looks like compared to pre-pandemic levels, and maybe throw in as well the read that you get on after-tax wages and salaries. Just how hot is this labour market still?
So from a savings and a deposit perspective, they are still 20+% higher than they were pre-pandemic. We have seen that come down over the last 12 to 18 months, very slowly. So they are spending through a little bit of that cushion, which was undoubtedly created by stimulus and changes in spending patterns when people were at home during the pandemic. So we're seeing it come down slightly, but I would say it's fairly stable. And it's significantly higher than it was pre-pandemic, which, again, I think is a terrific sign for the U.S. consumer. In terms of the labor market and the wage growth and what we're seeing in their accounts, again, we are seeing inflows and outflows in the accounts at a very healthy level. So they're not spending more than they're taking in. So they're adjusting on their wages. So again, really strong signs by the consumer.
Ollie, is there another period in financial history that this is analogous to in terms of the levels of both spending, of the cushion, of savings that you're seeing among consumers?
Looking back over the last several years, couple decades, I think the consumer is as strong as it's been. And I think we can attribute that to, great information. They're adjusting and they're really thinking forward in terms of what it will take for them to maintain their financial health.
Ollie, for next time, when Lisa says some people are looking for something to worry about, she just means Lisa is looking for something to worry about.
There are other people, too, who are looking for things to worry about.
Lisa always looking for something to worry about. Holly, we appreciate that. This was great. Really do. Let's do it again soon. Holly O'Neill there of Bank of America on the latest situation. I love this report every single time. It's not about what we feel. It's about what's actually happening, real numbers, in accounts, leaving accounts, and where that money's being spent.
I love it, too, especially because it gives you a sense that everyone already bought their refrigerators. They already bought their washing machines. They bought their stoves because they had nothing else to do during the pandemic. And now that shift has sort of stayed in place. But this doesn't represent anything to worry about, at least from that perspective.
The report has great charts, too, and you can see the service spending. It's just basically nonstop. It is persistent. You see this demand there for individuals that want to go out and travel in restaurants. The one thing she did say, though, is that people are starting to be a little bit more choiceful, maybe choosing a little bit more affordable restaurants to go out and dine in. But still, the spending, the appetite, it's there.
Next read on the economy, 8:30 Eastern Time, CPI and jobless claims. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. GSK shares rallying in the UK trade about 5%. The pharma company agreed to pay up to $2 billion to resolve about 80,000 U.S. court cases. The claims had alleged that a suspected carcinogen contaminated its old reflux medication, Zantac. According to people familiar with the matter, plaintiffs decided to settle the case. Delaware's Supreme Court signaled that it might walk back an earlier ruling that did go in their favor. GSK says settling is not an admission of liability. Bloomberg reporting that Bernard Arnault's family is nearing a purchase for a major stake, a majority stake in second-tier football club Paris FC. According to people familiar with the matter, the Arnault family will initially take a stake of about 55% through its holding company. In 2027, the family plans to buy out club chairman Pierre Ferracci's 30% holding. Red Bull will invest alongside the Arnault family and acquire a stake of about 15%. And the Mets are headed to the NLCS for the first time in 9 years after an electric elimination game over the Phillies. Francisco Lindor smashed a grand slam in the 6th inning, sending Queens into a frenzy and securing the series win. Elsewhere, the Yankees took Game 3 in their series against Kansas City behind a monster home run from Giancarlo Stanton. The Yankees and the Detroit Tigers will both aim to close out their series later this evening. And that's your brief, John.
Almost had a fight around the table there, Danny. Did the Mets news and not the Yankees, just for a heartbeat. Anne-Marie was about to lose it.
I mean, honestly, stop it. Just stop. I mean, seriously.
It was my first request when I came in, because I knew John was going to want tennis. I knew you were going to want Mets, and I was like, make sure you put the Yankees in there.
You want it, all right?
And I'm a little bit annoyed because when they showed this home run on on film, and I watched it this morning, they're just showing Giancarlo Stanton. You only know he hit a home run when he sort of tosses his back because he's so excited.
Okay.
They don't actually show the ball. We didn't see the home run into left field.
The Mets had a grand slam. They are now through the next round. Stevie Cohen, who is basically persona non grata in so many sort of public circles, now suddenly is a popular hero and is basically, the one that is being welcomed outside of Citi Field. I'm just saying, it's a pretty interesting story.
This should be the show. You want to carry on or no?
We can stop.
Okay. Up next on the program, inflation in America.
Presuming that the inflation data comes in relatively in line, right? But there's a pretty clear path for the Fed to cut, we think, to around maybe 3.5%, slightly higher in 2025. But then the conversations about the neutral rate of interest become that much more important.
The brilliant Claudia Sahm up next on the program, live from New York. This is Bloomberg. Stocks pulling back just a little bit. The data 40 minutes away. We're down 0.1% on the S&P 500. Yields are higher by a basis point or two, getting closer to 4.1% on a 10-year. Under surveillance this morning, inflation in America.
Presuming that the inflation data comes in relatively in line, right? But there's a pretty clear path for the Fed to cut, we think, to around maybe 3.5%, slightly higher in 2025. But then the conversations about the neutral rate of interest become that much more important. The mix shift of the economy is changing. The underlying kind of dynamics are different.
So here's the latest. Stocks sitting at all-time highs ahead of CPI, the Fed's next big data point after September's stronger than expected payrolls report. Claudia Sahm of New Century Advisors keeping an eye on the labour market and writing the following. The strong gain of 254,000 jobs in September was a welcome surprise after months of cooling in the labour market. However, 1 month does not make a trend, and even with the Federal Reserve cutting interest rates, a sustained turnaround in hiring will take time. I'm pleased to say that a good friend of this programme, Claudia Sahm, joins us now for more. Claudia, welcome back. Let's talk about Friday's labour market data and the increase in unemployment we saw through the summer. You came on the programme a number of times and suggested that maybe that increase in unemployment overstated some of the weakness that people might be thinking of. Do you think that maybe the report on Friday overstates some of the strength that people might believe there actually is in the labour market right now?
That's absolutely a possibility. Friday was a good day. That was a good employment report. The only bad thing about it is we don't have two more in our hands, right? So if we continue to see strength, and not necessarily that strong, we don't want to get greedy here, but if we have it, that strong, then yes, we'll look back on the summer and say, yeah, we wobbled and that was not good. Now, in the Bloomberg opinion piece that you pulled the quote from, I talk about the fact that the hiring rate, so the fraction new jobs out of employment at firms, it is still very low, 2013 low. And that until that hiring rate comes up, I will not rest easy, nor do I think anyone else. And I think the Fed probably feels the same way, because if that continues to be low, we will see slower job gains. We will see higher unemployment, and nobody wants to see that.
There's a worry of yours that I think we all share and we should talk about: lost potential. Can you talk to us about the risk of lost potential and how bad this could ultimately be for a single generation, maybe even more people than that?
Right. So I've spent a lot of time talking about the Sahm rule, so my recession indicator, and why it would work and not work right now. And frankly, I'm a little disturbed that the discussion turns into the 0-1 of recession, not recession. It's no, we do better than this. We do full employment, right? So to me, every person who's out there looking for a job, whether they're an immigrant, whether they're a native-born citizen, if they want to work, we ought to have them working. And if they're not, it's a lost potential. And we saw in this recovery our first job full recovery in decades. And if we look back to after the Great Recession, when I was radicalized into fiscal policy, that was a bad recession, and it was most bad for people coming into the labor market. There were years and years of a hit to income to some people, and that is absolutely unacceptable. And we don't have to do that again. And so to me, it's extremely important to keep the eye on the ball, which is our full potential.
Which is the reason why, Claudia, I think some people are talking about this Fed as a single mandate Fed. That's what Mohamed El-Erian called it, in terms of just focused on preventing further weakening in the labor market rather than focusing so much on the incremental moves in inflation. Do you think that structurally there should be more focus on preventing a real weakening in a labor market by the Federal Reserve rather than inflation, as long as it's below some point that may be a bit above 2%?
So the Fed has a dual mandate. It's the law. It's like, you don't like it, go to Congress, right? Like, they have price stability and maximum employment. Now, maximum employment means the most employment you can get without causing inflation. So it's still kind of like inflation is like center stage. But we are at a point, and Jay Powell, Fed chair, said very clearly multiple times, it is not necessary to have more unemployment to get inflation down. It's like, get a grip. Like, we're going to fight labor market because it needs a little support, or at least from the Fed, it needs them to stop like putting their foot on it, like pushing it down. And that, as far as I'm concerned, Jay Powell is well on his way to being the GOAT, the greatest of all time of Fed chairs, because this is the first full-on dual mandate Fed chair.
Claudia, do you think then that in about a half hour time, what we get from CPI even matters?
It always matters. Data always matter. But 1 month does not change the narrative. As I said, if it's a good month, it doesn't change the narrative, just like if it's a bad month, it doesn't change the narrative. We are looking for a sequence. I mean, I would love owner's equivalent rent to actually look like something normal, like what we know is coming. That's what I'll be looking for. And, we always want to look for signs. We want to look for risks, of inflation coming back stronger. But it's really hard to imagine a scenario. Please don't do it to us, Bureau of Labor Statistics, but it's very hard to imagine a scenario today that's a game changer. But it's also hard to imagine a scenario today that brings us the full clarity that we all want.
Claudia, very quickly, will we get that full clarity? Will there be more hiring after the election?
I think we're going to see a very slow process of that uncertainty coming out, because at the end of the day, the details matter, and we are not going to know the details on legislation and regulatory policy until well into next year.
Claudia, thanks for taking the time to talk to us this morning. We appreciate it as always. It's good to see you. Claudia Sahm there of New Century Advisors. Thank you. How concentrated the hiring's been in certain sectors. Healthcare, we've talked about that. Government hiring hasn't been that broad-based growth that we'd like to see in that 254,000 number we got last Friday.
There are still a lot of questions about how sustainable this is, which is the reason why people are looking for ongoing signs. And as Claudia said, maybe just don't put your foot on it.
Up next on the programme, the third hour of Bloomberg Surveillance looks like this. Mike Wilson of Morgan Stanley, Erika Najarian of UBS, David Kelly of JPMorgan and Greg Peters of PGIM. CPI in America just around the corner, 34 minutes away.
Presuming that the inflation data comes in relatively in line, right? There's a pretty clear path for the Fed to cut.
You're seeing inflation moving closer to the target. In that environment, you have to be closer to neutral.
They can continue a sequence of rate cuts, and they have a lot of room to cut interest rates here.
Inflation is really looking like it's getting back under control, that kind of the battle against inflation has been won.
The inflation question is back on the table.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Horder.
Mohamed El-Erian said it on Friday, straight after the payrolls report. Inflation is not dead. It's alive and well. That number drops in 30 minutes' time. The scores going into it look like this on the S&P 500, pulling back from all-time highs, just a little bit softer on the S&P 500. We're down 0.1%. On the Nasdaq 100, we're down also by 0.1. On a Russell, just a little bit of underperformance, off by 0.25%. The scores in the bond market, a lot of fours. We add some weight to these yields. We're up by 3 basis points at the front end of the curve, getting closer and closer to 4.1%. Similar move on a 10-year, up by 2 basis points to 4.09%.
You put this all together, and I really want to go back to this. I know some people are going to groan. Good news, good news. Basically, good news for risk assets, even if you see bonds sell off around the margins. In other words, can you continue with this? The sense that bonds are kind of their own thing in isolation and aren't going to break out too much to really derail some of the joy that we keep feeling 44 times over again this year.
When Mohamed came on after that blowout report, he's talking also about the fact that this Federal Reserve has amplified market volatility, and basically the bond market is anchorless. moving from data to data point. And now CPI takes on this whole new focus following that report.
Once we get past CPI jobless claims, it's on to earnings from the likes of JPMorgan, from Wells Fargo. Earlier on this morning, we heard from Delta. Delta just missing estimates just by a tiny bit, and then getting punished. At the lows this morning, we were down by more than 6%. Right now, Lisa, we're down by 3.4.
Yeah, they just had a terrible experience. Their adjusted earnings, their expectation is $1.60 to $1.85 versus the expectation of $1.75. So basically, just, completely in range, just maybe a little bit, a touch on the light side with their revenue growth guidance coming in, a touch on the light side. And this is the response. To me, this highlights the dissonance between the expectations, which are pretty high, the ongoing resilience you see from consumers, and the fact that companies are dancing on the head of a pin to fulfill those expectations. And that, I think, is what's going to be most interesting to watch during this earnings season.
The other risk right now is the election. And I say this because the Delta CEO said the airline anticipates a slowdown around the upcoming U.S. presidential election, which led to a 1 percentage point reduction in its unit revenue guidance this quarter. The same way we're hearing from Claudia Sahm that potentially we will see some more hiring that's been pulling back on the sidelines once we get an election outcome.
And the hope is that we get that outcome and get it quickly. That's the hope. I'm not sure if that's the base case. Is that the base case? How long will it actually take to get an outcome from November 5th?
There is a feeling that probably what's going to happen is whoever wins, there will be challenges. It'll take a while to know who that is, and then who knows how long this goes on. Key question for this market: does it matter what the election outcome is going to be as long as we have a president? What is the market expectation for not necessarily knowing for a prolonged period of time? That risk scenario is not getting priced into this market, but that is something that people are looking at.
Just a bit softer this morning. We're down by 0.1% on the S&P 500. Coming up this hour, Mike Wilson of Morgan Stanley as the S&P 500 hits its 44th record high of the year. Erika Najarian of UBS looking ahead to this week's big bank earnings, and David Kelly of JPMorgan reacting to the latest inflation data. We begin this hour with stocks at all-time highs ahead of CPI, the next key data point for the Fed after September's blowout jobs report. Mike Wilson of Morgan Stanley updating his outlook, writing Friday's strong jobs data and our economists' call for a series of 25 basis point rate cuts from here lead us to upgrade cyclicals to overweight relative to defensive. Mike joins us now for more. Mike, good morning.
Morning. How are you, John?
I'm good. It's good to see you. Let's talk about that overweight to cyclicals. Walk me through what's behind that and what kind of names you want to be behind at the moment.
Yeah, it's a very nuanced call. So I want to be crystal clear about what we like within cyclicals. Look, we're still not that convinced that there's going to be some big, robust recovery. That's when you really want to buy the early cycle kind of cyclicals, and we're not in that camp. We're still in the late cycle momentum here. But remember, this market has gone back and forth as the economic data has come in differently this year. Beginning of the year was a no landing scenario. Then we kind of reverted back to this sort of soft landing and then even a hard landing risk this summer. And now we're kind of back moving towards the no landing. So we're just trying to trade this back and forth. And we've been actually trading the rotations quite well this year. And so we're just taking we've had a great call on the defensives. We took that off 3 weeks ago. We neutralized that. And now we're just saying, look, you can step in a little bit more to the late cycle cyclicals. So that's quality names, right? It's not buying the early cycle junky, bad balance sheet type names. This is materials, this is industrials, okay? This is some of the quality, maybe software names to some degree, because they're pro-cyclical. It's not a wholesale, go down and buy the junk. That's what we want to make clear here.
I've been through enough cycles with you now to remember that also you mentioned, I remember a long time ago, late cycle energy. You didn't mention energy this time. Why not?
Well, I didn't mention it, but we are overweight energy.
Okay.
Now, that's been more of a hedge for us on the geopolitical risk. And we, to be honest, we had a bad call on energy. We kind of upgraded it in March. It worked really well until April. It's, hasn't done well since then. But now it's having a little bit of a comeback. So for us, we like materials and industrials more than energy. But energy is a good hedge against what's going on in the Middle East. And just, the fact that maybe things do accelerate and maybe we do get better demand in the energy side. It is cheap. Right, and that's the other reason we upgraded financials this past week, is because as rates go back up at the back end, financials tend to do a little bit better.
Okay, that's where I wanted to go.
Yeah.
This question of the relationship between bonds and stocks, because we saw for a while there was a feeling that if yields went higher, that would be punitive for equity valuations. And then recently, that hasn't been the case. Mm-hmm. Has that been surprising to you?
Well, no, think about this, right? So the Mag 7 or, some of the expensive growth names since July have really underperformed. In fact, that group has not made a new high. So the market is sort of punishing the more expensive stocks for the higher rates. And that's part of our call, too, is that part of this rotation back towards, say, quality cyclicals or some of the other names that haven't worked so well this year is just money leaving the big winners as rates back up. So as we wrote in the note last week, the biggest confirmation to me that this data last week was somewhat real is that 2-year yields in particular really ripped, okay? And 10-year yields ripped at the same time. That's the bond market finally saying, hey, maybe there is something to this soft landing and maybe things can actually hold in here, because the bond market's been very skeptical really up until last week. And that's a big deal.
So if I'm hearing what you're saying and taking it a step further, is it correct to say that the big tech companies, based on their valuations, are actually more highly levered to rates being somewhat lower, and that the cyclical companies are less sort of tied to that in terms of valuation? In other words, they don't need money to be cheap forever for them to maintain their valuation. Is that basically what you're looking at?
Yeah, and once again, we did neutralize our small cap versus large cap call this year. We don't want you buying small caps wholesale. Same thing, quality stocks do better, and not the low quality stuff. Because let's not forget, low quality, bad balance sheet small cap companies are not going to do well until rates really come down. All we're saying on the big cap tech stocks is there's two things going on. Number one, yeah, they got a little expensive. They're probably overowned, but also the fundamentals are deteriorating a bit, right? Last quarter, the market wasn't that excited about some of the spending the hyperscalers were doing without showing the returns they're getting on the revenue side. So that group to me looks like it's just taking a break. It's not that it's going to, crash here and rates are going to ruin the whole story. It's just they got overcooked, and we wrote about that 2 months ago. And since then, that's exactly what's happening. But that's the fuel for some of these other underperforming areas to work. Even China, quite frankly. I mean, part of the reason why China ripped so much, okay, was because there's so much money looking for a new theme. And it was like, oh my goodness, here's a new shiny toy, jumped in there, popped up, and now we're selling off again. And that's actually been our view too, is that we're not buyers of the big China stimulus. However, it can cause 20 or 30% moves because the market is desperate for a new theme.
Well, the new theme of the year so far, before October 2nd, were utilities. Utilities absolutely ripped. They topped October 2nd, 2 days before we got the payrolls report. Yep. As you pointed out, yields ripped, utilities have suffered. I want to talk about how timely that removal of that defensive overweight actually was with regards to that. Yeah. Were utilities a part of that call for you?
Well, it was. We basically, the whole defensive sector, we just said, look, you can fade it here. We definitely don't want you adding more risk within defensives. Utilities is definitely part of that. Now, utilities is interesting this year because it's a defensive play because of, it's always defensive, but it also has this power story. And so we kept that one as an overweight, but we're not adding to it here because of that secular growth sort of story. Now, it did sell off more than other defensives earlier this week because I think it's crowded. We showed in our 100th percentile of ownership within our institutional base of clients. So it's crowded. I think it can hang in here. The one thing about utilities that people don't appreciate is if we go back into a kind of hard landing scenario, I'm not predicting that right now, but if that were to happen, utilities tend to do poorly because their balance sheets are actually not particularly good. So it's going to be interesting to see if it can hold up into that. It should do better, though, in the no landing or kind of re-acceleration story.
Where do financials fit in? Why the upgrade going into earnings season?
It's similar to our call on the group, the quality cyclicals. So we were very distinct about this, too. We don't want to own the low-quality financials. We want to own companies that have the ability to see NIM expansion, can monetize that, or have capital markets activity. So those are generally your larger cap financials, your higher quality financials. And I think that's sort of been showing its hand. The other thing you have to keep in mind is earlier in September, there was an industry conference for the financials, and they did lower the bar quite a bit. So the expectations in that group going into this earnings season, I think, look particularly good.
You talked about the shiny new toy. I want to talk about the shiny new toy and the sort of rolling ball of cash that just is looking for a new theme. When will that rolling ball of cash not be a rolling ball of cash? When will we not feel like there's this glut of money looking to go somewhere? Why is that such a prevalent theme in all of market action so far this year?
I think it's just a classic late cycle phenomena, right? I mean, things are expensive, right? I mean, the Fed is cutting, but they're cutting because growth is now the worry. And that's what stocks need growth. We need, for a big sort of broad rally in the small caps, lower quality areas, we need either rates to come down in a more meaningful way to kind of jumpstart that recovery, or we need, a reacceleration from a new source of growth, and we don't have that right now. So instead of having that rising tide, what the market's doing is it's looking for individual themes. Last year was GLPs, it was AI, of course. Now maybe it's China. There's some industrialization theme that's been pretty exciting. We've been on that top of that one. But these are temporary, right? And the market is fickle. It will basically throw the shiny new toy into the dustbin as soon as it doesn't perform anymore. And we see that too. So you just have to be very, willing to be flexible. And we've adjusted our forecast this year for that same reason. You have to be flexible. You have to adjust what the market's giving you.
How flexible do you need to be after the election? I'm thinking of corporate tax rates. That's going to be a huge debate, as well as tariffs. Yeah,
so tariffs is the one that's easier because it doesn't need congressional support. I think the baseline view from most clients we speak to in our House view is that probably the most consensus thing is that we're going to have gridlock in Congress, right? It's going to be hard for one party to get a full sweep. So if that happens, then taxes is kind of off the table, for higher taxes. You could maybe see an extension of the tax cuts from 2017, so that's possible with congressional gridlock. The tariffs, though, can be enacted at the presidential level. So obviously in the Trump scenario, that's probably a worse scenario than it is with Harris. But I do think both administrations have shown their hand on that. I don't think tariffs are going away if Harris gets elected. I mean, I think the penchant there will be to kind of continue what the Biden-Harris regime has done for the last 4 years.
Do you buy into this narrative that maybe Kamala Harris is good for the bond market the way Donald Trump might be good for the stock market?
That's the way we've been talking about it for the last several months, is that Trump is probably not as favorable for the bond market because he's more of an inflationist, and the tariffs, of course, are part of that story. But also he wants to cut taxes. But the stock market may like that more, okay? And if you get a blue sweep, that's probably the worst case scenario for stocks, because then the risk of tax becomes legitimate.
How difficult is it to come up with an index level call for 12 months' time?
Well, it's always difficult. I mean, but I would say we've said this for a long time. I mean, this is the most difficult part of the cycle if you're true to your work. I mean, late cycles are always like we were just talking about. The market starts to rotate around because the opportunity set is less when you get into the later part of an economic expansion. So, 12 months is difficult. I would say the easiest time frame is 7 years. And we've talked about this before too, right? I mean, the only thing that you have over 7 years is valuation. And that's what we keep harping on. Valuations are expensive, okay? I don't care how you shake it. I'm not in this camp that, it's different this time. So if you're investing right now, you have to be with the mindset that you're probably not buying and holding for 7 years at these prices, right? You're going to have to be moving it around across sectors, across individual themes. And then we've also been very focused on stock picking. There's always stocks that work. And that's why I think, now the focus, CPI, I'm not that focused on the CPI today, to be true.
I don't think we asked you about it, to be honest.
Because I just think that's yesterday's news in many ways. And unless it's a 0.4 or higher, I think it's going to be a non-event for the most part. What's focused now for the market is going to be earnings season, right? And so idiosyncratic opportunities for clients, that's how they've been focused, institutional clients, that's where they've been focused, that's where they should be focused. And it's a great stock picking market right now.
Can you share a single name? And if you can't, can you describe it?
Well, I would say the way I would describe it is that the factors that are really continuing to work are quality and earnings revision breadth, or earnings revisions, to the upside. So 3-month earnings revisions, and that's how we're positioned. That's the quality cyclical trade. That's where the earnings revisions are now in the better mode. I would say some of the growth stocks, the big large cap growth stocks, their revision factors are starting to fade, right? Because they just got too extended. So that's the key. You got to focus on good is good, right? Bad is bad. And that's the main thing. There's no more of this bad is good. I think that party is over.
We're happy to leave that party behind. Mike, It's good to see you. Thank you, sir. Michael Wilson there of Morgan Stanley. Let's give you an update on stories elsewhere this morning with CPI 15 minutes away. We'll be watching it. Here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. The National Hurricane Center says that the center of Milton is pulling away from the coast of Florida after making landfall near Tampa last night. Florida Governor Ron DeSantis says that Milton's storm surge was actually less than that from Helene. Still, more than 3 million homes and businesses in Florida are without power. Delta shares still falling in the pre-market trade, down 3.4%. The airline reported third quarter profit that narrowly missed analyst estimates and gave a downbeat revenue forecast for the final month of the year. The report coming after Delta and other big airlines complained about a glut of seats in the U.S. this summer. Delta was also hurt by a technology-related system breakdown that led to thousands of canceled flights over several days in July. The government agency overseeing climate and weather research has issued a severe geomagnetic storm watch for today into Friday. An outburst from the sun was detected earlier this week. NOAA has notified FEMA that the solar storm could temporarily disrupt power and radio signals. Experts are concerned about potential effects this could have on power grids that are already impacted in areas by Hurricane Helene and Milton. The agency told operators of power plants and orbiting spacecrafts to take precautions. And that's your brief. John.
Hey, Danny, thank you. More from Danny in about 30 minutes' time. Up next on the programme, the morning calls, plus Erika Najarian of UBS as we look ahead to big bank earnings kicking off tomorrow morning from New York. Good morning. the open in about 1 hour and about 12 minutes away. 12 minutes away is CPI. So you've got all of that still to come. Let's get you some morning calls. First up, Truist upgrading Nike to buy, highlighting confidence in the company's new CEO. Next up, Morgan Stanley sticking with its overweight rating on Delta after earnings, recommending investors buy the stock on today's weakness. We're down by more than 3% in the pre-market. And finally, Bernstein downgrading PayPal to market perform, pointing to competitive pressure and valuation risk. Turning to the financials, big bank earnings kicking off with JPMorgan and Wells Fargo tomorrow morning, followed by Citi and Bank of America next week. We've got Erika Najarian of UBS around the table with us to break it down. Erika, good morning to you.
Good morning.
It's good to see you. Good to have you here in New York City with us. Let's talk about JPMorgan first of all.
Yes.
Dan Pinto came out and suggested that maybe we're a little bit too optimistic on earnings. Have we priced that in now?
I think so, and I think he's right. But here's the real rub about JPMorgan. With all that capital, they can earn whatever they want. So we have an estimate of $86 billion for net interest income for next year. When Pinto said that, net interest income was at 90. But they could buy Apple Card. They could, grow faster than you think because they have, so much capital. So he's right, but I'm not sure it's going to matter for the stock beyond Friday.
I want to ask you a question that you asked yourself in your own research. What do long-only PMs own? If they own JPMorgan and no other banks, what do they swap it out for?
Yeah, so they're not looking to swap it out. They are, in favor of the long-term story at Wells. They do think that there's going to be upside if rates are going to be lower on Bank of America. But the one stock where they're really sharpening their pencils because they think it's going to be, a transformational next 5 years for the company is Capital One, should the deal for Discover close.
Interesting. I thought you were going to say Citigroup, given the fact that there's been this whole transition going on over there. Capital One, though, is actually even more fascinating because of what we saw in terms of some of the fear around credit deterioration. How much is that something that's spooking people going into this, given some of the warnings that we heard in the last couple of weeks?
Yeah, I actually think the market is a little bit complacent on credit, Lisa. I think that what they're pricing into bank stock is perfect manifestation of a steep yield curve where deposit costs are coming down, loan growth is going to come back, and then there's going to be very quiet credit. I think the consumer data is going to be pretty quiet over the near term, but I'm a little bit nervous about 2025. I feel like spend is maxed out. I always joke with my clients, how many times can you go to Europe? How many $3,800 Bottega bags can you post on Instagram, right?
That's true, which is maybe what you're seeing in terms of discretionary. They only need one of those, evidently. Yeah. But there's this question about consumer finance. We heard from Ally Financial, you talk about Capital One. Yep. We're not hearing the same thing from Bank of America earlier this morning. We're not hearing the same thing from JPMorgan. How much is this a tale of two banking systems? Basically, those that were trying to pick up the dregs during the go-go days for a lot of consumer credit, at the same time that the Bank of Americas and JPMorgans were consolidating their power over anything that was creditworthy.
Yeah, so that's a great question. Look, I think that given the nature of regulation, BofA and JPMorgan have always focused on the prime consumer. And the prime consumer is quite healthy right now. That being said, Ally could be a canary in the coal mine, right? So everybody has said, it's going to be just a lower income consumer, just a subprime consumer. And again, if the Fed sticks the landing perfectly, great, right? You're not going to see that bleed up. But I think that, it always starts with spend. So for me, the first sign is spend slowing down significantly in 2025. We're coming upon holiday season, so we could have continued, strong spend on card. But as I think about next year, as I think about the savings dwindling, as I think about, wage growth not keeping up, as I think about prices still being high, I think you will see a slowdown in spend.
Which large banks are most vulnerable to that at a time where it feels like in the popular zeitgeist, there's a feeling that interest rate risk is really the one to watch with the big banks and the credit providers like Capital One and Ally Financial, it's credit risk. Mm-hmm. Is that accurate, or is it actually the big banks are going to start to feel the credit risk too?
Look, I mean, if the normal U.S. consumer stops spending and if we have a little bit of blip in unemployment, you have the big card portfolios at JPMorgan and Citi, they're going to feel it too, right? So, they're not going to be spared. They just have more diverse sources of revenue, especially JPMorgan, way more so than Citi.
There's a name we haven't mentioned, Wells Fargo. Lifting the asset cap. Just run through the last few years over at Wells Fargo and how revolutionary that could all be, how big a change we might see.
It all doesn't happen like this, right? Let's say they announce that the asset cap is lifted today. they're not just going to turbocharge the growth on their balance sheet. But a couple of things can happen. Number one, Wells has this great market share in terms of providing credit for corporates. They can now get even bigger in terms of, helping them with their investment banking and capital markets needs. They could be bigger in terms of helping institutional investors with their needs. That usually needs a lot of balance sheet. And so I think that could be the most immediate thing that you could see. And look, net interest income is balance sheet times net interest margin, not loans times net interest margin, right? So their ability to gather deposits, grow balance sheet, it was the institutional money that they sort of said, we don't have room on the balance sheet for you under the asset cap. I think eventually that could be a big deal for the stock. And it could be, pave the way to, mid-teens return on tangible common equity and $6 plus of earnings.
So with the 30 seconds we have left of the major financials, the report tomorrow and through next week, top pick. What is it right now?
I don't love the setup for any of them, but if I had to pick, I would pick Wells. I think there's a lot of concern over the near term on net interest income, but at the end of the day, it's always going to be regulatory. Is it a turnaround story? Is it a credible turnaround story? And I think that is going to be way more important than near-term gyrations on net interest income.
You're one of the best. We appreciate it. It's good to catch up. Thank you. Thank you. Erika Najarian of UBS on the bank earnings tomorrow morning. JPMorgan and Wells Fargo, then on to next week, where you get all the rest. In just a moment, about 5 minutes away, we get CPI data in America. We'll be catching up with David Kelly of JPMorgan and Greg Peters of PGIM right here around the table to react. Equity futures on the S&P 500 negative by about 0.1%. In the bond market, we're holding on to 4. Let's see if this sticks at the other side after we get the CPI data in just a moment. The 2-year yields are higher by 2 basis points. On a 10-year, we're up by a single basis point, approaching 4.1%. From New York City, your CPI data up next. "20 seconds away from the economic data in America. A focus on 2 things, CPI and," Mike McKee walks in, "don't forget jobless claims." Jobless claims just moments away. The scores going into this, just about negative by 0.1% on the S&P 500. Likewise on the Nasdaq, down by a little more than 1/10. In the bond market, a lot of 4s over the last week. At the front end of the curve and the long end, the 2-year 4.04%, yields higher by 2 basis points, up a single basis point on the 10-year to 4.08. With the data, here's Mike McKee.
All right, let's take a look at CPI. Comes in a little bit hotter than anticipated, up 0.2%, same as last month. Forecast was for 1/10. The core comes in up 0.3. That is also a little bit hotter than forecast. 0.2 was the belief. 0.3 was what we saw in August. The year-over-year numbers, 2.4% for the headline, not as good as anticipated. And for the core, 3.3%, not as good as anticipated. So maybe this will catch a little bit of wind, given the fact that we had seen the big, strong jobs report last Friday. Now, speaking of jobs, we get a big jump in jobless claims, 258,000. Now, that's up from 225 the month before. But caution on this one, this follows the hurricane. And so we are probably seeing a lot of people in North Carolina, Tennessee, Georgia, who are filing initial jobless claims. We'll take a look at that. But I wouldn't connect the dots between the CPI, the jobs report, and jobless claims.
Well, it's certainly a struggle to respond to it, Mike. And I can tell you that struggle is playing out in the market. Initially, after you saw those jobless claims number, this bond market rallied pretty hard at the front end of the curve, even though CPI came in a bit harder than expected. Right now, we're down about a single basis point on a 2-year, just in and around 4%. In the equity market, we were bouncing all over the place as well on the S&P 500. Futures stay negative by just about 0.2%. But I'd characterize this morning, Bramo, just looking at that on the surface, as a bit of a tug of war between a hotter than expected CPI and a worse than expected jobless claims rate.
Yeah, just to give the jobless claims a little bit of perspective, it's the highest jobless claims amount that we've gotten since August 2023. We're also seeing the biggest pop in a percentage basis going back to December 31st of 2021 when it comes to jobless claims. So taking a look at that, it's either an aberration to his point or it's something else that people have been looking for. And that, I think, is really important to watch.
Mike, we've got one more payrolls report, and that payrolls report could be pretty messy. based on some of this?
Well, definitely. We're anticipating a lot of jobs lost to the hurricane before we even get to Milton, Hurricane Helene. And I know David's with us. Folks at JPMorgan had made an estimate looking back at previous hurricanes, just based on Helene, that we could lose 120,000 jobs during the month of October, could come off of the payrolls report. Throw in 38,000 people who were on strike against Boeing, and you could end up with a negative print. Now, it wouldn't affect the unemployment rate, but it would be something really hard for the markets to digest, a market that isn't sure what the Fed needs to do here.
David Kelly at JPMorgan Asset Management with us around the table. David, I think we have to start with the jobless claims number, and welcome to the program. What do you do with that 258? I'm sure clients are going to ask you about that throughout today. What do you tell them?
Well, we're obviously going to look at the states and just see, was this weather? But I'm not too worried about it. I mean, the way I look at it is, right now, the Atlanta Fed is looking at a 3.1% GDP growth rate for the third quarter. And we did 3.0 in the second quarter. That is a lot of momentum. And we know that employment follows GDP with a lag of 1 or 2 quarters. So we know that the broad mosaic of jobs is we're creating jobs. The economy is still motoring along. And so we'll figure out what's causing the aberration. We'll try to. But we do think it's basically an aberration. There's no sign that the labor market's strengthening much, but it's no sign that it's weakening either.
But does this basically underscore why, even though CPI, which evidently we've all but forgotten, the fact that it came in hotter than expected doesn't really matter? That essentially this is a Fed that's going to be more focused, whether it's an aberration or not, on those jobless claims?
Well, I think we've got to reconcile ourselves to the fact that we've now got a normal, good economy. It's not so much a late cycle or an early cycle, it's a post cycle. We've got an economy which is motoring along with inflation at 2 point something and unemployment at 4 point something. And that combination's pretty good. And it looks like it's going to keep on doing this for some time to come here. There's nothing endogenous within the economy that is going to make this economy tip either hotter or cooler. It's just going to trend along at a steady growth pace. So from the Fed's perspective, look, if the economy's in good shape, we can just gradually bring rates back to a normal level. And rates are still too high. So I think that they will gradually bring rates back to a normal level.
When would you get nervous about jobless claims? Because a lot of people were saying those were the highest frequency item to look at with the labor market. What kind of tick up would get you worried?
I'd get nervous if I saw other things going on in the economy also. I mean, obviously, if we saw a few weeks of this, and we saw it show up in continuing unemployment claims. We saw it in layoffs. We also saw it in terms of corporate behavior or some of the earnings reports of the third quarter. If we saw a general sign that everybody's pulling back, then I get nervous. But it's hard for me to get nervous in an economy which will naturally chug along at 2%. I mean, that's what it's going to do. The population grows every year. The working age population grows. We're running a productivity growth, 1.5% to 2%. It's going to chug out twos. And if we were a little short one quarter, we're going to be higher the next quarter. So the thing that gets me really worried is what could change that narrative? What big shock, really big shock, could hit this economy and just take us out of these lanes? Because we're basically in a soft landing lane, and it's just continuing.
You say one of those big shocks could be fiscal policy.
Yes, that's right. I mean, one of the things, obviously, it's a very, very tight election. We're less than a month away. I'm particularly worried about tariffs, actually, because that's, it looks to me like most likely we're going to end up a divided government. I mean, of course, we might not, but that looks most likely. And then you don't get big fiscal policy change because one house of Congress tries to, offset what the administration is doing. But on tariffs, the president has control. And if we engaged in a big tariff war and we sort of put 10% tariffs on everybody and then they retaliate and we say, we're going to go 20%, that's the kind of thing that could actually cause a stagflation recession. I mean, it is a stagflation elixir. You can then cause inflation to bounce up, and those unemployment claims, they're going to start bouncing up too, because what you're going to do is lose manufacturing jobs in the export sector. So that's one big shock that we could impose upon ourselves in the short term. If we get into a tariff war or a trade war, because we decide to try and fix our fiscal problem with tariffs, that's a potential own goal.
Absent that risk, how vulnerable are we to a stagflationary shock? Some people might look at this number on the surface, claims have broken out, inflation's still sticky. They might be throwing around the S word this morning. Would you throw around that word?
No, just the opposite. I mean, if you add up a 2.4 on inflation and a 4.1 on unemployment, that is a 6.5. That is better than those numbers have been 89% of the time in the last 50 years. We are in the opposite of stagflation right now. We've got motoring along with low inflation. It's actually a good economy.
At what point does inflation come back onto your agenda, given the fact that just looking in this, energy was actually lower? It was actually a negative influence on CPI. It was the other factors that are seeing price increases. And what we're seeing with companies is they're maintaining margins because they have been able to raise prices on consumers.
Well, but they're also maintaining margins because they're able to beat back on wage demands, which I think is another part of the story. I would get worried, apart from what I just said about tariffs, if we had a broadly expansionary fiscal policy. We did a lot of, suppose we threw money at lower and middle income households in America next year for whatever reason. If we do that, the problem is we're already at full employment. And so if you put a lot of money into lower middle income households, either through tax cuts or checks for whatever reason, then you can cause inflation. Or we could have something terrible happen in the Middle East. I mean, if you have a problem which causes a hot war in the Strait of Hormuz and tankers literally can't get out, you got a problem. So there's always something that's going to go. It's hard to see what that thing is. But the reason you diversify is not because of what you expect. It's because of stuff that you don't expect that ends up biting you.
David, it's wonderful to catch up, sir. It's good to see you. I know you've got to run. David Kelly there of JPMorgan Asset Management on the latest economic data. If you are just joining us, CPI out just moments ago, 8 minutes ago, coming in just a little bit hotter than expected. Core CPI, excluding food and energy, coming in at 3.3% year over year against an estimate of 3.2. Month over month, that came in at 0.3 against an estimate of 0.2. Jobless claims came in at 258. The estimate in our survey was 230. McKee, have you got a state breakdown now? Could you tell us state to state where some of the weakness came from?
Well, the interesting thing is the state by state data are a week behind, but the states that saw the biggest declines in jobless claims 2 weeks ago were Georgia, Florida, Texas, Virginia, states where, with the exception of Texas, the hurricane hit. And so people couldn't file because probably a lot of the offices were gone and nobody could get to them. So next week, watch for those states to bounce up again. Unadjusted claims up 53,000. I mean, clearly this is something happened in the economy, and it's likely the hurricane. Interesting thing with CPI, though, the things that went up were the things that have been going down, and vice versa. We have the best housing numbers we've got in about 6 or 8 months, with owner's equivalent rent up just 0.3 and rent of shelter up just 0.3. But food at home goes up 0.4 after being flat for 7 months in a row. That's going to bother people and could be a campaign ad for somebody. Motor vehicle insurance was up 1.2% and airline fares up 3.2%. We'd seen issues with those. But even apparel goes up 1.1%. That may be retailers who were getting ready to deal with a port strike.
I think it's pretty much guaranteed that will be a campaign ad. If you want to know what the markets are doing, equity futures on the S&P 500 look a little something like this, a little bit softer on the S&P 500. We're down by 0.4%. Greg Peters of PGIM is with us now to break this down as well. Greg, we can start with claims or we can start with CPI. What stood out for you?
I think what's continued to be really important is the labor market. I think inflation is still last year's story. Yes, there was an upside surprise there. But at the end of the day, it's about labor, and that's the clear focus on our end.
Greg, given that, basically you look at this report and you see jobless claims come in bigger than expected. Is that basically the go buy long bonds signal for you?
Well, I think the real complicating factor here is the data coming out is going to be very cloudy and distorted. You have a bunch of strikes, you have weather, hurricane, et cetera. So it's really going to be difficult to suss out what's truly happening on the labor side. There was a lot of, interesting kind of peculiarities of last report. So at the end of the day, we're in a data-driven world. When the data is coming out in not a clean fashion, it's going to make for a very volatile, uncertain backdrop heading into December.
Greg, we've had a lot of switches in narratives, and we've been talking about that, the no landing, the soft landing, the hard landing, the no landing again. Who knows where we are? Good news is bad news. Now good news is just good news. At a certain point, what's your sort of guiding viewpoint right now after the Fed cut by 50 basis points? The Fed minutes come out. Clearly there was dissent, not a lot of willingness to cut more aggressively. What's your sort of roadmap for the next 6 months?
Yeah, so my roadmap is essentially the economy looks pretty decent on our end. Yes, labor is showing some signs of weakness on the margin, but on balance, the economy looks pretty reasonable here. Also, you have a situation where the North Star is that the Fed is on an easing path, and I think that's what's important. If you look at the distribution of what's being priced in the SOFR market or the futures market, traders and investors are really thinking, okay, the Fed is protecting the downside here. So it might not be as fast as anticipated, but if things do unwind quicker on the economic front, then there is the belief that the Fed can move more quickly. And I think that is a bullish backdrop.
They're protecting the downside and potential fallout from the labor market, although today we do see inflation hotter and we had a blowout jobs report on Friday. Do you think the 50 basis points cut was too much of an insurance cut?
I think you can debate whether it was 50 or 25. I actually don't really care so much about that. Either way, they were in highly restrictive territory, and I think they'll continue to become less restrictive. So whether they cut 50 or 25, last meeting, I think is less important. What's more important is just the steady path. And I think the belief is that there's a steady path towards easing, and that is the tailwind, all else equal.
So you agree with David Kelly of JPMorgan when he basically says the path for the Fed is just to follow the dots, except he says if there's a shock. And when he's talking about a shock is coming from we could do unto ourselves in the United States, a fiscal shock or potentially a geopolitical one. Is that what concerns you the most as well?
Yeah, so very much related to that, what we do fret at PGIM is a resurgence of inflation. So a lot of the policies that are being put forth, who knows how they'll actually play out if they can get through Congress, of course. But on the margin, it's inflationary. So what I worry about as a risk factor for 2025 is, even though we're all talking about inflation being last year's story, it resurfaces again, and that changes the whole narrative around what the Fed can do to protect the downside in the economy.
Greg, this sounds like a very personal question, but it's not. How do you sort of manifest fear, given the fact that selling isn't necessarily the way to deal with it?
Yeah, so I think the way to think about it is just your overall risk applied to the market, right? And so even though, we have a pretty, reasonable backdrop penciled in, soft landing, let's call it, for the U.S. economy, when we layer in valuations, there's a lot already in the price. So what that says to us is that even though we're pretty positive from an economic standpoint, you're not being rewarded for that positivity. And so we're dialing back risk. So we are, much less risked up on the spread side than we've been. And we still believe that, the Fed and interest rates and duration can come to the rescue in times of need.
Good vibes from Lisa, as always, Greg. It's good to see you. Greg Peters of PGIM.
Right.
Never change, Bramo. Never change. We often say on this program, you can learn something from the data and you can learn something from how the market responds to the data. What have we learned from the data? That inflation's still a little sticky, that maybe possibly that upside surprise on jobless claims is down to the hurricane and will largely be temporary. What can we learn from how the market has responded to the economic data? Well, we can just look at the front end of the curve. Yields are dropping. So at the moment, the market is putting more weight on jobless claims than it is on that hot CPI data. That might fade through the day. We'll see what the session looks like. But that just speaks to this idea that still, even if you can explain away that weakness in jobless claims, Lisa, this market is still very nervy about the prospect of a pronounced weakening coming around in the labour market, even with that blowout report that we had on Friday.
To take it a step further, this is a market that believes in a one mandate Fed. that is watching jobless claims much more than inflation, and that a little tick up here or there isn't going to make a difference on CPI, but it will make a difference if you see just a little tick up in jobless claims.
We're down 2 basis points at the front end of the curve, 3.99, just a little break of 4. Small moves, no drama. We'll see if they stick. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Just to go through those numbers again, jobless claims coming in higher than expected, CPI hotter than expected. Core CPI increased 0.3%, a touch hotter than the 0.2% expected. Headline CPI, though, is still at the slowest annual rate since early 2021, largely due to cheaper energy. Shelter and food combined accounted for over 75% of the overall monthly advance. Elsewhere, jobless claims, there was a 258,000 jump. North Carolina had a 290% increase in claims, the most of any state. Median rents have fallen in New York City for a fourth month out of the past 5. In Manhattan, the figure fell 3.4% to $4,200 in September. Those new figures come from Douglas Elliman Real Estate and Miller Samuel. Prices also slipped for Brooklyn and Queens, but even with the decline, the median rent is just $200 off the record high. The market is still fiercely competitive. Bidding wars broke out and nearly a fifth of new leases signed in Manhattan. Tesla getting ready to unveil its highly anticipated autonomous taxi prototype later tonight. The robotaxi will be revealed at Warner Bros. Movie Studios in California, where Tesla has reportedly been collecting fresh mapping data in the lead up to the event. Tesla CEO Elon Musk is expected to outline his vision for the Tesla network, which owners can add their autonomous vehicles to a robotaxi fleet when they're not using them. And that's your brief, John.
The future of the auto industry. Danny, appreciate it. That stock, Tesla, off the lows of April, is up by almost 70%. And the carrot over that stock, this story for most of this year.
The idea that as we get older, if somebody is so impaired after a night out, if they have children, they can just have a car come up and take them away. They don't have to own a car, just the future that you could see. Why are you laughing at me?
Because the total addressable market is bigger than just that very specific, unique story that may or may not be about
Hold
you.
on a second. Okay, pause. There are lots of scenarios. Think about, not just that one.
I know there's lots of scenarios. Okay. That one was just very, very perfect.
All right, move on.
Lisa's thinking of her nights out.
No, you think that I'm just this crazy partier on weeknights? Can you imagine? Yeah, go out till 8 p.m.
Up next on the program, setting you up for the day ahead. You're watching Bloomberg TV. The opening bell about 37 minutes away. Equities near session lows on the S&P 500, down 1/3 of 1%. The calendar and the trading diary. The week ahead looks like this. At 10:30 Eastern Time, we'll get some more Fed speak for you from Barkin tomorrow. PPI and UMich consumer sentiment. Plus, big bank earnings kicking off with JPMorgan and Wells Fargo. Turning the page to next week. Tuesday, more results from Bank of America, Citi, Goldman Sachs and United Airlines. Wednesday, earnings from Morgan Stanley. And finally, an ECB decision a week away. Mike McKee still with us around the table. Mike, you've had about 20 minutes to go over the data now. What jumps out for you?
Well, on the CPI side, the fact that housing went down. Now, CPI was raised by other things, and some of it may be related to retailers raising prices ahead of the port strike, which may fall out of the data. But it was interesting that things like new cars, used cars that had been going down went up, apparel went up, and food went up. It was only really gasoline that went down a lot. So that was kind of interesting. And I think the jobless claims is the hurricane. And that will probably remain elevated for a couple of weeks now because it got another hurricane. So a lot of people in Florida are going to be filing jobless claims numbers. So this data probably doesn't tell the Fed a whole lot, but it is interesting because you mentioned Tom Barkin, who's a voter, speaking this morning after this data, after the jobs report data. Does he really think we need to cut rates again at the moment? And if so, only 25? that'll be this is what we'll be watching from these guys from now on.
Mike, you've been through a lot of cycles. You've seen a lot of hurricanes. How much is this really something we can just shrug off as noise versus people who actually cannot get back to work, considering different disruptions in infrastructure and the like?
Well, it's obviously a tragedy for all of those people, and it will hurt the North Carolina and other economies around there, bring down their growth rates, raise their unemployment, which raises their costs, et cetera. On a macro sense for the United States, it tends to wash out because you end up replacing older buildings with lower value with brand new buildings that cost a lot more, so GDP goes up. And we will see probably jobs in those states start to rise as construction workers and people come in. So it washes out of the national economy, but you can never put a price on what it does to the local economy.
I want to go back to food because this comes after a Quinnipiac poll came out yesterday showing Trump actually cracking some of the Democratic hold on the blue wall. And then you look at the issue like the economy, he's winning across those 3 states, Michigan, Pennsylvania, Wisconsin. What is going on when it comes to food inflation?
Well, that's a good question. When you look at the breakdown, fruits and vegetables were up almost 1%, as were meats, poultry, fish, and eggs. I know eggs has been a big issue on the campaign trail, but fruits and vegetables come in from outside the country for the most part. We see, imports of stuff that maybe because there was an anticipated shortage that the prices got raised ahead of time. We'll have to wait till next month to see.
Eggs, cats, dogs, everything. Mike, good to see you. As always, good to catch up. That wasn't lost on you. Come on.
That wasn't us. Is that food at home or is that food out?
Coming out tomorrow. Okay. That was an easy one. I was teeing that up. John Stolfers of Oppenheimer, Gerald Cassidy of RBC. We'll catch up with Michael Kushner of Morgan Stanley, Lara Raim of FS Investments from New York. This was Bloomberg Surveillance.